There is real damage happening today, right now.
There's a lot of bad sentiment, and that's helped the market recover.
People are looking for some amount of clarity.
Markets are very jumpy and very uncertain these days.
The appetite for U.S. assets could be something that is a question.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to a long weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, and Chair Powell isn't coming to the rescue.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. Markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation. Markets are doing what they're supposed to do.
Stocks are heading for a week of losses as the Fed chair looks through market dislocations, focused on anchoring inflation expectations.
Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem.
Tariff anxiety fueling the fastest retail sales growth in some 2 years as consumers look to get ahead of potential price increases. Ford is preparing to do just that as soon as May if the president doesn't deliver on the relief that the auto sector is hoping for. The clock is ticking.
The clock is ticking, Jonathan, and we see these negotiating teams arriving in Washington, try to strike a deal. Yesterday, we have the Japanese negotiators in town. The president joined that meeting. He said there was progress, but yet they have to schedule another meeting. And that is really going to be the litmus test for what other trading partners should be doing. Scott Besson had said to me earlier in the week, first mover advantage. If the Japanese come out and are able to strike a deal, everyone is going to be looking to them. What were they able to extract? What kind of concessions also did they have to give in order to get this over the finish line before those 90 days are up?
Chair Powell isn't blinking. Is it fair to say the president is taking a softer tone with allies over the last week?
I think it is fair, given the fact that he joined those negotiations yesterday, came out and said, I'm going to be part of the negotiations. I believe they sat with the president himself for 50 minutes before sitting down with Scott Besson and Commerce Secretary Howard Lutnick. And then today, who do you have arriving in Washington, D.C. to try to have an olive branch, this whisper of Europe, Giorgia Meloni, the head of Italy, coming to town. She is going to try to help the European Union get over the finish line with some sort of deal for this reprieve that they're dealing with right now, these 90 days.
Some kind of deal, some kind of relief. The auto sector's looking for the same thing. What we saw yesterday in retail sales were consumers front-loading purchases, and you saw that in sales of autos as well, specifically. Purchases of autos up more than 5% in the month of March. Ford getting ready to raise prices on cars coming out of the factories as soon as May. That's how much time we've got here.
I think the issue you take with this, if you look at, say, Ford having to do this, Ford is looking at raising prices. Ford is the best positioned auto manufacturer in the United States because some 80% of their cars are made in the U.S. And even they're saying we are unable to withstand this 25% levy. And we're going to have to look at, and all these tariffs, we're going to have to look at potentially raising these prices. It also comes at a time the president insinuated earlier this week that he may give the auto sector a reprieve. Still, corporate America is saying, we don't know yet, so guess what? We're going to have to put the prices higher on consumers.
This market whipsawed right now between trade talk hopes, trade talk fears. This morning, trade talk hopes. It's frustrating, isn't it? Futures are up by about 0.75% on the S&P 500. Later on this morning at 8:30 Eastern Time, you'll have jobless claims. Before that, an ECB rate decision. So a couple of things to look for going into the long weekend. Coming up this hour, we'll catch up with Sharon of Goldman Sachs as the volatility continues. Tobin of Wolfe Research as Trump signals progress in trade talks. And Angelo Zino of CFRA on the latest tech sell-off. We begin this hour with stocks rising on positive signs from US-Japan trade talks. The team over at Goldman Sachs staying somewhat cautious, writing the following. We would argue that we are in an event-driven bear market triggered by tariffs. However, it could easily morph into a cyclical bear market given growing recession risks. Goldman's Sharon joins us now for more. Sharon, welcome back to the programme. Let's sit on those recession risks. Is it fair to say that they're receding over the last week, or are they still elevated from your standpoint?
I think they're still elevated. Whether they're absolutely at peak, perhaps they've receded from those peak levels. when there was no scope for negotiation on these tariffs. Now that clearly has started, but they're still relatively high. I think we regard it as 45% chance of a recession in the US over this next year. That's a relatively high chance versus a standard year, and that's because of all this volatility and all this uncertainty.
This market lost a lot of confidence in US policy at the start of this month, Sharon. In the eyes of the Europeans, can you talk to us about changing perceptions of US assets? Have they been damaged over the past few weeks, and how repairable is that damage?
So Europeans have loved US assets in the last 10, 15 years. You've absolutely seen Europeans pivot towards the US, and you see this in many different guises. For example, companies, corporates invested more in the US. They moved more of their divisions to the US, etc. over time because the US has had much better growth. But also investors as well have loved the Mag 7. They've loved the opportunity to invest in tech stocks. They've loved the fact the dollar's been very, very strong. So Europeans absolutely love the US market. They've been one of the reasons that the US has done so well. You've seen a lot of flows into the US over time. That is being questioned a little bit, yes. I mean, not completely. I still think that the US over the next few years will outgrow Europe, but perhaps the gap will narrow a bit.
Can the flows make a U-turn if we get deals done within these 90 days?
I don't know if they will make a complete U-turn because there's a lot going on here. It's not just the tariffs. For example, it's the dominance of US tech globally. Is that now being questioned a little bit with competition, lower cost models coming from elsewhere, the extra capex and investment these companies are having to put in? They're no longer capital-light businesses, for example. It's other issues in Europe itself. For example, fiscal spend by Germany boosting growth in Europe. So I think that there's a combination of things here, and tariffs are just one part of that.
When it comes to looking at the entire policy perspective from the United States, I talked to the Treasury Secretary about this, and he said his advice to the investment community would be you have to look at everything together, the entire stool, which is tariffs, deregulation, and tax cuts. Do you get more bullish on the U.S. as we go down the calendar?
Because you're starting to see some of those other things come through, maybe tax cuts, etc. I think most of the tax cuts that we expect to happen will just be extension of the ones that are already in place. And I think most expect that to happen. So yes, there may be a little bit of relief on that side, but the more that's done on that side, because the tariffs, whatever ultimately comes through, are probably inflationary, whatever relief you give the economy on the fiscal side will probably mean less relief on the monetary policy side. So no, I don't necessarily think that that means a huge boost to growth.
Sharon, can we just sit on monetary policy? What are you expecting from monetary policy on either side of the Atlantic? We heard from Chairman Powell yesterday. We'll hear from President Lagarde later on this morning.
Yeah, well, we do expect the Fed to cut rates 3 times this year. We're not looking at a recession scenario. If we were, it would be deeper rate cuts. But we think that the Fed has got room to cut rates modestly from here. Although it's a balancing act, as Powell has pointed to, because the tariff and the tariff uncertainty is really causing a little bit of inflation risk to seep through into the US economy, even if there is lower economic growth. But the ECB, I think the equation's much easier, as we've been discussing earlier. I think the ECB will cut this week. Today, you've also got, in our view, more rate cuts to come from the ECB down to about a rate level of 1.5% this year. And the reason for that is economic growth in Europe is not that strong, but you've not got the inflationary impulse from the tariffs that potentially you've got in the US.
If anything, Sharon, they might face a disinflationary bust. Now, I'm not sure that's anyone's base case right now, but let's say the walls stay up in the United States and the tariffs stay on. China's got a lot of overcapacity and Europe might have to eat it. What does that mean for some of the earnings across the continent and the prospect of disinflation in the months and years to come?
Yeah, I mean, not all things about disinflation are good news for Europe. Europe has suffered under too much inflation in recent years, and that's been a hit to the consumer. So obviously, if there's more imports of low-priced China goods into Europe, it's great for the consumer. Also, energy prices have come down. That's good for the consumer. So there are plenty of good things, but there are also some risks for, say, European manufacturing if you see more imports from China. So I agree it's a balance. I actually think European earnings this year for stock 600 companies, for example, won't be that strong. The reason for that is weaker global economic growth, but also tariff risk, falling energy prices hitting the energy stocks, and the stronger euro hitting all the dollar earners in the index as well.
But when it comes to consumers, hasn't the euro appreciating actually helped them? Because right now the Commission hasn't retaliated against the U.S. tariffs.
I know, look, the European consumer's been very beleaguered in recent years, particularly around COVID, around the energy crisis, incredibly high inflation, negative real income, generally weaker European currencies and a stronger dollar. All of it's been bad news for European consumers. But actually now I think we're starting to see the reverse of that. So definitely some winners in Europe from this. Lower cost goods potentially coming in, but also lower energy prices as well, and a bit of a stronger currency, giving them more purchasing power. I couldn't agree more with that. But it's a bit of a balance here. Consumers do a little bit better, but then other parts of industry may suffer. Having said all that, not super negative on European manufacturing. Obviously, you've got the fiscal spend and the defence spend coming through in Europe as well, which will give a boost to that.
Sharon, let's just finish on earnings season. On this side of the Atlantic, the financials projected confidence. We saw that from JP Morgan and for the institution you're a member of as well. What are we hearing on your side of the Atlantic? Because what we've seen from the luxury players, LVMH, Hermes, maybe a struggling Chinese consumer. What do you hear on your side of things?
Yeah, I don't think this is going to be a brilliant season for European companies. I think financials actually will do okay. Rates are still generally relatively high in Europe. Even if rates start to come down at the shorter end, long end rates still being relatively high, so a steeper yield curve, not such a bad thing for some of the banks out there, financials. They're also often quite hedged for rates coming down too. So I'm not too worried about that group of companies, but there are others that perhaps will see a weaker first quarter. Those exposed to China, you mentioned, energy, for example, given energy prices have fallen through the quarter. So there are aspects, for example, of European earnings which are probably not going to see a stunning first quarter. Another sort of element of exposure is the dollar having fallen over that period of time. That's bad news for dollar earners, and they're a big portion of those in the European index.
Sharon, appreciate your time. As always, good to catch up. Send our best to the team. Sharon Bell there of Goldman Sachs on the latest over in Europe and their views on what's happening right here in the United States. Euro-dollar at the moment, euro-dollar 113.68. We heard it from LVMH, Pernod Ricard, seen it from Hermes as well. Bit of a struggle over in China.
Absolutely. That Chinese consumer is not holding up when it comes to luxury space. You know what's interesting as well about Hermes? They're talking about the fact that they're raising their prices as of May 1 in the United States to deal with the tariffs, because there's still a 10% tariff. Even though there's a reprieve on the higher reciprocal level, there's still a 10% tariff for those European goods coming into the U.S.
Some companies can get away with it, and I would say that's a company that can get away with it. We'll talk about them a little bit later. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief. President Donald Trump sharing on Truth Social that trade talks with Japanese officials have led to big progress. A deal has not been reached, but preparations are underway for a second round of talks later on this month. Elsewhere, Ford is preparing to raise prices on cars if President Donald Trump doesn't deliver on tariff relief. The price increase would affect vehicles built in May, but wouldn't change pricing for those already in inventory. And finally, Nvidia in the crosshairs of US-China trade tensions. The CEO, Jensen Huang, is in Beijing after the Trump administration curbed the sale of its H20 chips to the country. Huang reportedly meeting with clients, including DeepSeek's founder. This is going to be very interesting today at a time when the Chinese leader is going around meeting with Asian allies, trade partners, talking about one big Asian family.
And it looks like Jensen Huang is trying to get ahead of what is going on in the U.S., the fact that they're looking to curb more of their exports to China, and also they're looking into potentially if any of those chips, Jonathan, were used when it comes to DeepSeek.
More on Nvidia later on this morning. Equity futures so far in the S&P, nicely elevated going into the long weekend. Up next, the art of the trade deal.
The tariffs are larger than forecasters had expected, certainly larger than we expected, even in our upside case. We looked at a range of cases. All of this is highly uncertain. That's why we're waiting really to see what the policies ultimately are.
Up next on the program, Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning. Equity futures on the S&P positive here by 0.6% as the president says we get closer and closer to potentially a deal with Japan. Talks making, quote, great progress. Equity futures elsewhere on the Nasdaq up by about 1 full percentage point. In the bond market, yields declining for 3 consecutive sessions, so a bit of stability returning to the bond market. This morning, though, we snapped that streak. Yields high by 3 basis points at the front end of the curve on a 10-year up by 2. And the euro in focus with an ECB rate decision just around the corner. Euro-dollar negative by a third of 1% to 113.65. Good morning, Mr. President. putting this out on social media this morning. The ECB expected to cut interest rates again, and yet, too late, Jerome Powell of the Fed, who is always too late and wrong, yesterday issued a report which was another and typical complete mess.
So basically, he's once again jawboning Jay Powell, this time comparing him to Christine Lagarde. How come she's cutting rates and you're not? Too late, should have lowered interest rates like the ECB long ago, he goes on to say, but he should certainly lower them now. Powell's termination cannot come fast enough. I spoke about this with the Treasury Secretary. Says nothing to worry about right now, but in the fall, Jonathan, they're going to be interviewing candidates to take over when Powell is over in May 2026.
Do you think it's fair enough that Chairman Powell won't get an interview? Do you think that's fair to say?
I think that's fair to say at this point, especially when the president is literally saying in black and white to the world, his termination cannot come fast enough.
Termination's a very interesting word. Does that mean we allow the term to expire, or do we explore something else? I think people will be thinking about that this morning. What does that word actually mean?
I think people will be thinking about that. And I will say, before I sat down with the Treasury Secretary, because we were promoting it, I actually got asked. People were asking me, because of that Supreme Court decision that said the president at this moment was entitled to oust those top officials at two independent agencies, there was concern in the market about whether or not he would try to oust Jay Powell. We have to remember the independence of the Fed is a cherished pillar of why you invest in the United States.
It will be interesting to see how the market interprets those comments and what kind of clarification we get from the administration later on this morning. Equity futures still just about positive by 0.5%. Under surveillance this morning, the art of the trade deal.
The tariffs are larger than forecasters had expected, certainly larger than we expected, even in our upside case. We looked at a range of cases. Our role is to make sure that this will be a one-time increase in prices and not something that turns into an ongoing inflation process. All of this is highly uncertain. We're thinking now, really before the tariffs have their effects, how they might affect the economy, and that's why we're waiting really to see what the policies ultimately are.
Here's the latest this morning. Chairman Powell isn't blinking, keeping the focus on President Trump, stating, quote, big progress was made in the latest round of trade talks with Japan. Bloomberg's Tyler Kendall joins us now for more. Tyler, encouraging on the trade front between the United States and Japan. But that headline that just crossed the Bloomberg terminal, those comments from the president on Truth Social referring to the chairman of the Federal Reserve, Jay Powell. Your thoughts on that this morning, please.
Yeah, hey, John. Well, President Trump saying that Powell's termination can't come soon enough. Of course, we know that he's expected to leave his post in May of 2026. And as Annmarie said, she asked Scott Bessent earlier this week, who said no need to worry right now, but that they are going to start to look at other candidates starting in this fall. President Trump has long suggested that he should have some sort of comments over input when it comes to FOMC decisions. And he's really linked this directly to his tariff policies, often saying that lower interest rates would go hand in hand with him upping tariffs on our trading allies. So while, of course, President Trump has continued this trend, this perhaps appears to be the staunchest rhetoric that we have heard from him when it comes to an actual termination. Of course, NEC Chair Kevin Hassett has repeatedly said that this White House will respect the Fed's independence, but it remains to be seen if the rhetoric's going to keep ramping up as President Trump tries to imply that Powell is behind the curve.
Well, Powell yesterday said the tariffs are even higher than their upside scenario the Fed was modeling. Tyler, we had the Japanese delegation in yesterday, and today we have Giorgia Meloni visiting Washington, D.C. What does she come with?
Right. Well, Annmarie, this is largely seen as a test as to whether or not Meloni can use her affinity with President Trump to try to advance trade talks, particularly when it comes to the European Union. Of course, we know Meloni was here for President Trump's inauguration, considered to have a relatively good relationship with this White House, as President Trump says that he will be directly involved in all of the negotiations going forward. It's our understanding that Meloni is coordinating closely with European Union officials, which their negotiations haven't necessarily gone as well. Bloomberg News reporting earlier this week that the EU trade chief left talks in Washington with very little clarity on exactly what this White House needs to get a deal done. Now, our reporting does indicate that Meloni is expected to propose that all tariffs should be eliminated on bilateral trade between the EU and the U.S., essentially creating a free trade zone. Really remains to be seen whether or not that's something that this White House would entertain. One proposal, though, that might actually get a little bit more traction, Meloni is also expected to suggest that there should be a EU and UN-U.S. Trade Summit, where allies can come and talk directly with senior administration officials, both on trade but also defense, because, Annmarie, we know that this administration in particular is pushing for our NATO allies to boost their defense spending, and that likely will make their way into the talks today.
Tyler, appreciate the update. Tyler Kendall in Washington, D.C. I think we've got a new top story. This from the president this morning. The ECB expected to cut interest rates once again, and yet too late. Jerome Powell of the Fed, who is always too late and wrong, yesterday issued a report which was another and typical complete mess. The president goes on to say too late should have lowered interest rates like the ECB long ago, but he should certainly lower them now. Powell's termination cannot come fast enough. Joining us now to discuss, Tobin Marcus of Wolfe Research. Tobin, I would love your response to how you're interpreting that post from the president this morning.
Yeah, termination is not really the word that you necessarily would want to read from the President of the United States about the Fed chair. I do think that as a matter of prudence, it's still not likely that Trump is going to make a move to actually fire Powell. You know, as a legal matter, I do think that there's no real distinction between the Fed and the agencies where he has tried to establish a new right to dismiss independent agency heads like the FTC. So there's going to be litigation about that. To the extent that the administration succeeds in that litigation, that would establish his right to dismiss Powell. But I think that they're just not going to do it based on the market reaction. I mean, similarly, in their executive order asserting regulatory control over independent agencies, they made a point of saying the FOMC is not covered by this when it comes to monetary policy. And I think we're going to see the same approach in terms of personnel.
Tobin, are your clients concerned about Fed independence?
I think there are enough other things going on in markets that are concerning institutional investors that this is, at worst, kind of a vague worry in the back of people's minds. There's so much noise out of this administration, as we've seen in the tariff roller coaster since Liberation Day, that I think for the most part, this is going to need to be seen to be believed in terms of markets, like really trading this like it's materially impactful for their portfolios.
Do you have a sense who some of the administration's top candidates are to replace Jay Powell?
I think there's a lot of overlap with the names that were in conversation for the Treasury Secretary job last fall. I think Bessent is certainly a possibility. We could see the old Dick Cheney move of sort of recommending yourself after interviewing various candidates. And then Kevin Warsh is a name that I think continues to be in the mix as well.
Tobin, speaking of the Treasury Secretary, when he spoke to Annmarie earlier this week and she talked to him about the potential timeline for replacing Chairman Powell, he talked about interviews later on in the fall. There was a conversation on the campaign trail going into the election that maybe they'd select almost a shadow Fed chair, someone they'd select ahead of time who would go around making speeches and maybe the market would cue off what that individual was saying versus saying what Chairman Powell would say. Is your base case that they will not do that, or is that something you're still open-minded about?
So I'm not sure that they're going to formally designate a shadow Fed chair, and I recall that proposal came from Bessent, I believe. It was first anonymously sourced and then kind of reported from his own mouth. So obviously in a position to try and effectuate that plan from his current seat if they want to. So, I don't know that it's going to be that formal, but I wouldn't be terribly surprised to see them making a relatively early decision about who it is that they're going to put up for that job, trying to run the confirmation process essentially in advance, and, trying to turn attention to that person a little bit rather than the actual outgoing Fed chair in Powell.
Tobin, appreciate your update and your reaction to this one as well. Thank you, sir. Tobin Marcus there of Wolfe Research. If you are just joining us, these are the headlines that come from the president this morning. He's complaining about the Federal Reserve not doing enough to reduce interest rates. Looking at the ECB, who's about to cut interest rates again, and I imagine it's annoying the president this morning, and going on to say too late, which is a new nickname, I suppose, for Chairman Powell, should have lowered interest rates like the ECB long ago, but he should certainly lower them now. Powell's termination cannot come fast enough. Now, how this market interprets this story is important, and at the moment it's not interpreting it in a too negative fashion. Equity futures still positive by 0.6%, but that's a very loaded, powerful word to use on a morning like this morning.
The start of his truth, we've heard this before. He's annoyed with Jay Powell for not moving and cutting interest rates. It's that last sentence, this termination. Is he talking about May 2026 when Powell's term is up, or is he talking about doing something sooner, which would definitely unnerve investors because that would blunt the independence of the Fed?
As we look for clarity on that, equity futures right now still positive across the board, on the Nasdaq higher by about 1 percentage point. Up next, Angelo Zino of CFRA on the latest tech sell-off from New York. This is Bloomberg. Interesting start to this morning. Equity futures still positive by 0.6% on the S&P. On the Nasdaq 100 up by 1%. The president saying they've made great progress with the Japanese in talks so far this week on the trade front. This is what the president said just moments ago and on Truth Social, complaining about the chairman not reducing interest rates over at the Federal Reserve, unlike the ECB, which is expected to cut interest rates later on this morning. He should certainly lower them now. Powell's termination cannot come fast enough.
So I think market participants will say, we've heard the president talk about the fact that he's allowed to have an opinion. He thinks he understands where the economy is better than anyone else, especially monetary policy. So maybe they understand why he's voicing his concern about being too late. What is going to unnerve investors is the fact that last sentence, he says his termination cannot come soon enough. Is the president willing to wait till May of 2026, or is he going to do something else that is going to make a lot of people very concerned because they want to see an independent Fed in the USA?
Mike McKee's in the building. We'll catch up with Mike a little bit later this morning to get his thoughts on all of this. I want to get to some movers just briefly. Nvidia down almost 7% in yesterday's session, bouncing back just a touch this morning, up by 0.6, down 22% on the year so far, as the US slaps more curbs on chip sales to China. Interesting to note that Jensen Huang, the CEO, landing in Beijing today, so look out for headlines from that. I want to turn to Hermes and get you an update on luxury. Hermes this morning, negative by 2.5%. A rare sales disappointment from the luxury goods maker. Chinese shoppers reining in spending. Saw something similar from LVMH earlier this week. Plus, price rises coming in the United States at the start of May.
So you saw a lot of these luxury players actually double down in the U.S., say the U.S. is where we can make sure we have these luxury consumers, especially if China's looking a little bit weak. Now they have to deal with the fact that, are these luxury consumers still going to buy when prices go up? And Hermes is saying prices are going up May 1st because of tariffs. The issue is they're in a league of their own. And I think if you can already afford a $20,000, $25,000 handbag, you could probably afford it if it's going to go up 10%.
Can you say the same thing about a Ford? We'll get to price hikes there in just a moment. On our radar this morning, President Donald Trump saying, quote, big progress has been made in trade talks with Japan. Japan's lead negotiator meeting with Trump for 50 minutes and U.S. negotiators for 75, with another round of talks expected later this month.
This is really important because Besson has said to me that the first mover advantage potentially is the one that's going to get the deal at the start of the day. So you have to imagine those 70-plus partners are looking at how the Japanese are dealing with this administration. And if they are going to get a deal first, what are the contours of that deal? The concessions, the extraction, does it have to do with non-trade barriers, or is it really just about tariffs? That is going to be key for everyone else. They're really writing the pathway for success, potentially. We have to see what the deal comes in the end.
Auto's a big feature of this conversation. I mentioned Ford, so let's get to it. Preparing to raise car prices if President Trump doesn't deliver on tariff relief. The company planning to make adjustments for cars rolling off assembly lines starting next month, with the vehicles set to arrive in U.S. showrooms in late June or early July.
This is what they said in the memo. We anticipate the need to make vehicle pricing adjustments in the future, which is expected to happen with May production. Why is this? Because right now, they still have the tariffs in place, some of these tariffs, even though, Jonathan, there is full court press lobbying from the automakers to the White House trying to get some more reprieve. At the end of the day, if they don't have clarity, what we've seen, whether it's Hermes, whether it's Ford, they are moving ahead and raising prices to make sure they're not impacted on their bottom line.
The stock is up by 0.6%. Elsewhere, Taiwan Semi keeping its growth outlook for 2025 despite tariff uncertainty. The company expecting AI revenue to double and reiterating a goal set in January for mid-20% growth this year. Staying on tech, Nvidia looking to recover from Wednesday's declines after the Trump administration restricted its chip sales to China. Angelo Zino of CFRA writing, we estimate that this development puts about 8 to 10% of the country's revenue tied to China servers at risk and could empower domestic China competitors, specifically Huawei. Angelo joins us now for more. Angelo, welcome to the program. What was your reaction to that news yesterday? And what do you anticipate Jensen Huang's going to do in China later on this week?
Yeah, so thanks for having me, John. You know, when I look about what happened yesterday, interestingly, you know, I'd say about 2 or 3 weeks ago, we had an internal meeting, and my belief was probably at some point in May, we'd actually see a GPU ban into China. And I'd say that kind of really fell off the table really quick after there were reports that Jensen had met with President Trump at a Mar-a-Lago dinner. And, essentially that was almost kind of put off the table, right? So you kind of sit here yesterday, you look at the 7% pullback in the shares. That's probably about right in terms of the risk exposure, in terms of from an earnings trajectory for NVIDIA here, as far as the H20 is concerned. When you start thinking about the lack of exposure now in China, that meeting that Jensen had in China. Again, I mean, what Jensen has done here over the last couple of years is he's fought really hard to stay into China. There's been a number of export restrictions out there. They've had to continue to temper the performance on those GPUs, and really kind of the H20 is a China-specific GPU. So really, I think the meeting there is for Jensen to kind of just continue to say, hey, listen, we're committed to China. We're going to have to try to do it maybe another way. But, it's an important market. It's the second largest market out there. You've got some major hyperscalers in the likes of Alibaba and Tencent out there. So Jensen wants to be out there in terms of the NVIDIA exposure.
Angelo, the good news for NVIDIA is they don't have a demand problem. They've got a supply problem. Can you say the same about all the other chip makers?
You can't, in some respect, in the near term, I'd say, NVIDIA is best positioned, even when you kind of hear Taiwan Semi's call just a couple hours ago. They kind of alluded to the fact that they are still supply constrained on the AI side of things. So that does bode well for NVIDIA. But it isn't necessarily about NVIDIA's prospects here over the next 2 to 3 quarters. It's about the sustainability of demand as we go into 2026. And you do see some risk of that now, or increased risk, if you're not able to play in that China market, which again, potentially is about 8 to 10% of their current revenue, at least on the data center side of things.
Angelo, do you think the company is thinking about developing a new chip that can go to China, given the fact that the H20 was manufactured and developed so that it was able to export to China, given the U.S. export controls?
Yeah, I mean, I think we have to see what those new export controls look like, and if there's any way that NVIDIA and AMD can circumvent some of these new restrictions or what have you. But when you start looking at this new administration here, there's a part of me that thinks that they don't want NVIDIA to have any exposure, at least kind of on the AI side of things, in China. Again, remains to be seen. We'll see. They'll try to some extent, but I don't know if they're going to be successful this time around the way they were successful under the Biden administration.
How are you thinking about the sectoral tariffs when it comes to semiconductors that the president promises that we're going to see?
Yeah, I mean, and that's a good question. You look at right now, there's a Section 232 investigation that's going on. We're expecting some sort of implementation at some point in the second half of the year. Our base case right now is the fact that you're going to see some sort of tariffs. That is going to be a permanent effect on the semiconductor industry and the broader hardware industry. But our view is the base case is somewhere along the lines of a 25% tariffs. Obviously, anything significantly above that is going to be a risk. And there is, some hope on our end that it's going to be less than that. But when you look at the semiconductor industry specifically, one area that does have pricing power is the chip industry. They've been able to kind of pass higher prices on over the last couple of years, obviously, on the leading edge side of things specifically. So our view is any type of tariffs that are announced or put in place is going to get passed through to those hardware manufacturers, which ultimately, if you're a company like Apple, will push that down to onto the consumer themselves.
Angelo, just before you go, how are you navigating earnings season so far? TSMC came out projecting some confidence, keeping their guidance basically unchanged. ASML, some disappointing orders from them. Do you put more weight on one versus the other at the moment?
Yeah, I mean, I think Taiwan Semi is the bigger play as far as kind of gauging the demand prospects across the broader semiconductor industry. I think, as far as going through earnings season is concerned, I think most of these companies will be relatively in line as far as semiconductors are concerned. I think the guidance also is going to be roughly in line. Most companies are probably going to keep a lot of their guidance in place, but most investors out there probably won't believe what the outlook is going to be, because it's more along the lines of what the second half in 2026 is going to look like. As you kind of go into the second half of the year, If the consumer doesn't show up this holiday selling season, you're going to start seeing inventories build, and that's going to end up being an issue for the semiconductor industry. So I think all eyes right now is going to continue to be on the policy side of things, and really that's really going to dictate how these semiconductor stocks move here over the next couple of weeks and months.
A tough 24 hours for the chip makers, that's for sure. Angelo, appreciate your time, sir. Thank you. Angelo Zino there of CFRA on NVIDIA and a whole lot more. If you are just tuning in, welcome to the programme. Some very strong words coming from the President aimed at Fed Chair Jay Powell. This line right here, Powell's termination cannot come fast enough. With more, here's Mike McKee. Good morning, Mike.
Good morning, John. This does appear to be the first time that the president has actually threatened to fire Jerome Powell. He's criticized him since he returned to office, but hasn't said anything about terminating him. Now, the question is, of course, can he? Powell has said he won't leave if the president asks him to, and that he would fight any kind of termination. This all gets back to a case that's being fought over the head of the National Labor Relations Board, Gwynne Wilcox, whom the president fired. The argument is that under, you've heard the term Humphrey's executor, that the president can't fire somebody except for cause, the head of an agency, independent agency, except for cause. The administration argues it can. So the question is now before the U.S. Appeals Court for Washington, which has let Wilcox go back to work while they figure this out. But it's anticipated to go to the Supreme Court. Now, the question is, would it get to the Supreme Court and would they make a decision in time to really matter with Powell, whose term is up in May of next year?
Mike, Powell talked a little bit about this yesterday. What was his response?
Well, he was asked about it again, and he said no, he has no intention of leaving. He's going to serve out his term. The interesting thing, Annmarie, is that he hasn't defined what his term is because he has two. He has the chairman's term, which expires in May of next year, but he's also a member of the Fed Board of Governors until 2028. If he were to leave the chairman's job right now, there would be no openings on the board, and the president couldn't appoint anybody. So it's going to be a very interesting situation, shall we say. I don't want to say it's a court case yet, but very interesting situation as this plays out.
Potentially. Mike, thanks for the update. We'll come back to you later on this morning. Mike McKee there on the president's words this morning. Language is important. That would be my question to the press secretary today. Termination. What did the president mean by that? Did he mean the expiration of his term as Fed chair in May of next year, or did he mean something else?
I think that's a great question, because he just said termination cannot come fast enough, meaning I'm waiting out these next 12 months, or I am prepared to take action because I'm annoyed that he has a new nickname for him. Too late, Jay Powell is taking too long to cut interest rates.
You probably want to know how the market is interpreting this morning. So far, OK, still just about positive on the S&P 500. The S&P is higher by 0.4%, but rolling over. If you check out the bond market on a 2-year, 10-year and 30-year maturity, yields just a little bit higher, up by 2 or 3 basis points on a 10-year at 4.30. I imagine if we were in a situation where the President of the United States fired the Fed chair, we'd have a very different market reaction to the one we've got right now.
Absolutely. I think the market's looking at this and they're saying this is the rhetoric we have heard from Trump in his first administration, and we've heard it from him again as he's president in his second administration. He jawbones. He likes to have an opinion about the Fed, where interest rates are going, and about the individual himself, Fed Chair Jay Powell. If he was to do something, I really think he will have a market reaction, because before I sat down with the Treasury Secretary, this was something individuals were messaging me about. Please ask Scott Bessent what he makes of the Supreme Court ruling that at the moment the president can oust of top officials at independent agencies.
Certainly giving up the gains this morning. Still positive, but only higher by 0.4% on the S&P. Let's get you an update on our top stories this morning. If you are just joining us, our top story. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social, he's too late and too wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough. Elsewhere, United Health shares are down after reporting first quarter earnings below expectations. The health insurance giant cut its earnings outlook for the year. The company now missing targets for medical costs several quarters in a row. Their stock is down by 19%. And your final story, Meta CEO Mark Zuckerberg wrapping up 3 days of testimony in the FTC's antitrust trial. Zuckerberg responding to evidence suggesting Meta bought Instagram and WhatsApp to eliminate competitive threats, arguing the acquisitions did not harm competition. Their stock is just about positive in the pre-market. Up next on the program, the president sticking to his words.
People are looking for some amount of clarity. I look at this term of the Trump administration somewhat differently than the way we looked at the last one, in that almost he is sticking to his literal word when we're talking about tariffs and trade here.
In just a moment, we'll catch up with the former senior Trump trade advisor, Kellyanne Shaw. She joins us next, and we'll give you an update on the president's comments this morning on Fed Chair Jay Powell. Equity futures still just about positive here, up by 0.4%. On the Nasdaq 100, up by 0.7%. Just got a message about the Dow. Why don't you quote the Dow? Because United Health is 9% of the index and hardly anybody owns the Dow. And if someone's screaming at you this morning talking about the Dow being down, seriously, choose a new TV network. The Nasdaq right now positive by 0.75%. That is why we don't talk about the Dow on this particular program. All right, rant over. Let's get to another rant from the President of the United States. This is what he's got to say. Powell's termination cannot come fast enough. What a line by the President of the United States.
I'm thinking he's the one that actually messaged you, because we do know that he is one of those individuals that actually likes quoting the Dow, and in his first term used to use it all the time, depending on how good his presidency was going. This line, Jonathan, is very hot, because it is not just saying, I can't wait for Jay Powell to not have that job anymore. His termination cannot come fast enough. Is the president talking about the end of his term as Fed chair in 12 months, May 2026? Or is he talking about something a little bit more nefarious in terms of firing Fed Chair Jay Powell?
If you want to take the temperature of the bond market this morning, there's no freak out to this headline. I think that's important. How is the market interpreting that headline this morning? Yields are up by 2 basis points on a 10-year to 4.30. At least for now, no real drama.
I think so. Now, the market participants, I think, are seeing this as just Trump rhetoric. Trump taking the truth, voicing his concerns. He probably saw what Powell said yesterday. Definitely different than, say, what Governor Waller was talking about in terms of where he's leaning on with the mandate, the concern he has about inflation and about tariffs. So the market right now is just viewing this as Trump's voicing his opinion. He's done this before. He'll do it again. But if this was to move into potentially a firing, I think you'd have a very different market reaction.
Mohamed El-Erian, 11 minutes away. He's going to have his reaction to that story in just a moment on this program. Under surveillance this morning, the president sticking to his word.
People are looking for some amount of clarity. I look at this term of the Trump administration somewhat differently than the way we looked at the last one, in that almost he is sticking to his literal word when we're talking about tariffs and trade here.
Here's the latest this morning. President Trump signaling big progress in trade talks with Japan, fueling Wall Street hopes that agreements can be reached to avoid higher tariffs on trading partners. Kellyanne Shaw, the former senior Trump trade advisor, joins us now for more. Kellyanne, it's good to see you.
Good to see you as well.
What are the prospects of making a deal in this smaller time frame with this many countries?
Well, I think the chances of making a deal with Japan seem pretty high, right? Like, you've heard Bessent talk about the fact that there are about 15 countries with whom they're close to making a deal. I don't foresee 90 countries in 90 days, but certainly with some of our major trading partners with whom we have some of these significant issues, I do think the administration is very optimistic.
Let's talk about the one that's a little bit harder, China. They came out this week with a number of demands they'd like to see a response. By the way, we should note this was a Bloomberg scoop, according to someone familiar with the CCP thinking right now. Do you think this administration is ready to appoint a point person for Beijing to deal with?
Well, I think both sides are looking to see if there is an off-ramp, right? Like last week, we backed ourselves into a trade embargo between the two world's largest economies. So there has to be a way to resolve this at some sort of political level. And I think appointing someone seems like a reasonable way forward. But that said, the president has said that he wants to negotiate directly with Xi Jinping. So there's going to be some negotiations behind the scenes to see if they want to back off that approach or if they're willing to delegate one level down.
Do you think the likely scenario here is that there's a call and then they appoint someone, and then who do you think that individual is going to be?
Well, of the constellations of actors who it could be Secretary Bessent, could be Secretary Letnick, it could be someone like Jameson Greer. But I do think that in the last week or two, we've seen Bessent really take the lead publicly in terms of advancing some of the president's trade agenda points. So he would be a likely interlocutor with the Chinese.
When it comes to the other deals, and speaking of China, the secretary has insinuated he wants to shore up some of these other deals and then confront China together. Is that the kind of concessions they're looking for when they talk to Japan or the European Union or Vietnam?
Well, I think, like, taking a step back, this is existential from the perspective of the administration, that we are overly reliant on China, that the Western world has become overly reliant on China. And so it makes sense from their perspective to look at building alliances with other countries where they adopt some of the same measures that the United States does. And even from the perspective of third markets, if the United States and China are in this posture of not trading with one another, those goods are going to go somewhere else. They're going to flood other markets. And so I think that's what they're trying to get to. But the question for me is, some of these Asian nations in particular, are they going to pick sides? Are they going to be willing to put up some of these barriers on China or not?
So when it comes to other investigations the administration is launching, we learned this week there is an investigation, a Section 232 on pharmaceuticals, on semiconductors, that was launched April 1st. Why did we learn about it this week?
Yeah, I have to say, I spent 10 years in government and have never heard of a secret 232, but that's effectively what we saw happen. Well, there is no legal obligation to notify the public that an investigation has been launched. There is a legal obligation to give the public an opportunity to comment. But some of this may have just been, there's so much going on that they failed to alert the public. Could be that they were just investigating and sort of got out over their skis. But for whatever reason, it's neither here nor there. We're in an active investigation, and the administration has 270 days to complete those investigations.
They have 270. How quickly can they wrap it up?
As soon as almost humanly possible. So that comment period is, I think it's going to be May 7th when all those comments are due. They could potentially announce the results as soon as May 8th. Now, I don't think it will be that soon. I think they'll give themselves another month to digest some of the comments. But we've heard Secretary Letnick say that within a month or two, we're likely to see some of those measures.
A couple of names in the mix right now. Who do you think's running the show at the moment?
I think Donald Trump. I think President Trump is running the show. He has always been his own trade advisor. But of the economic advisors who seem to be in the mix, Secretary Bessent, Secretary Letnick, Jamieson Greer.
Does it surprise you that the Treasury Secretary has almost made a U-turn when it comes to these negotiations in the past 2 weeks? When I spoke to him after what Trump called Liberation Day, he said he wasn't part of the negotiations. He then clarified to me this week he meant he wasn't in charge or a part of the negotiations regarding the tariff rates on that big chart. How big of a disagreement was those reciprocal tariffs?
Yeah, in Trump 1, it was very clear that we had different advisors on different spectrums. So we had the free traders, we had the protectionists. In Trump 2, the difference between them is much smaller, right? So I think you have advisors who might have different perspectives, but their view is largely rowing in the same direction. So I don't see the same break in the same way, but I do agree that Secretary Bessent is much more active now in terms of driving some of the agenda, at least in terms of the public voice of the administration.
And this is certainly something market participants wanted to see, including Jamie Dimon at JP Morgan, who basically said that in a Financial Times interview earlier this week.
He said he's an adult in the room and he likes that he's now taking a louder voice when it comes to these trade negotiations and thinks he should be the point person. Neil Dutta has talked about this, the ascent of Bessent. And he said Trump has cracked a lot of eggs and now it's up to the secretary to make an omelet. So Wall Street is definitely feeling more comfortable that the Treasury Secretary is the one who's a bit more careful with his words when it comes to these negotiations. He's in the driving seat.
Kellyanne, it's good to see you. Thanks for dropping by. Thank you. The former senior Trump trade advisor, Kellyanne Shaw there. The president breaking some more eggs this morning with this headline on the chairman of the Federal Reserve, Jay Powell. Powell's termination cannot come fast enough. Those comments dropping in the last hour.
Parsing through these words, it's confusing. Does he mean the termination of the end of his term, or actually, I will do what I can to try to terminate this individual from that job? His term is up May 2026. Scott Bessent said, nothing to worry about here. We will start interviewing candidates in the fall, and we have some names that we're thinking about constantly in these conversations he has with the president. So at the moment, I'm going to go with what Bessent said.
More reaction to those headlines in just a moment. Equity futures on the S&P positive by 0.4%. Up next, Mohamed El-Erian of Queen's College, Cambridge, Michael Zezas of Morgan Stanley. We'll catch up with Alicia Reese of Wedbush and Boivin of Blackrock. From New York, this is Bloomberg.
I'm concerned that you might have a freezing in the real economy here. The risk is real, and I think it's happening right now.
It really doesn't seem like there's any sort of catalyst that is going to change that narrative very easily soon.
The baseline is that we don't get a deep, lasting recession in the U.S.
The actual brunt of all of this, is likely going to be seen in the data in the early summer, even midsummer.
You got an economy that's probably in recession today, but I think as you get to the back half of the year, things can really evolve.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures still elevated by 0.5% on the S&P 500. On the Nasdaq 100 up by 0.7 as the president stresses great progress has been made in talks with the Japanese over trade. Coming up later on this morning, you'll get jobless claims, another read on the labour market at 8:30 Eastern Time, and an ECB rate decision at 8:15, followed by a news conference at 8:45. The president of the United States with some thoughts on the ECB and the Federal Reserve this morning. Why is the ECB cutting interest rates and the Federal Reserve isn't? That's a question he's got, and he stresses the following. The Powell's termination cannot come fast enough. That line from the president on social media in just the last hour.
It's the most important line, and it's the line that's getting the most questions. Is Trump talking about Powell's end of term in May 2026, or is he talking about doing something else, trying to remove Jay Powell from his post, which Powell said would be illegal and he has no plans on leaving? It is not clear what the president meant when it comes to that term termination, and so far, Jonathan, we have not gotten a response from the White House.
Well, the chairman quoted Ferris Bueller just yesterday in an address at the Economic Club of Chicago, saying life moves pretty fast. For the time being, we're still well positioned to wait for greater clarity before considering any adjustments to our policy stance. The Fed chair's not blinking here. Hasn't really blinked at all in the past few weeks, and I think he doubled down on that in yesterday's speech.
And I also think he doubled down on the fact that these tariffs, he was talking about they're even higher than what their base case was, or their highest case scenario. I thought it was interesting, Jonathan, that he quoted Ferris Bueller, because there is a famous scene in Ferris Bueller when the teacher is asking about tariffs and the economic calamity it caused. It's that Bueller moment. And I think he quoted Ferris Bueller, a different part of the movie, but my head went straight to that scene.
You can ask him if that was deliberate or not the next time you see the Fed chair. Big hour coming up. In just a moment, we'll catch up with Mohamed, El-Erian of Queen's College, Cambridge, on America's uncomfortable tariff journey. Mike Zezas of Morgan Stanley as President Trump signals progress on Japan trade talks. And Jean Boivin of Blackrock as Fed Chair Jay Powell stays on the sidelines. We begin this hour with stocks higher as the president signals positive US-Japan trade talks. Mohamed, El-Erian of Queen's College, Cambridge, writing, the US has taken its economy and those of other countries on an uncomfortable journey to an uncertain destination. This will severely test the financial system and America's global standing. Mohamed joins us now for more. Mohamed, looking forward to spending the next 2 hours with you. Good morning.
Good morning. Thank you, John.
Want your reaction to this headline here from the president in the last hour. So out on Truth social media platform, the president's following maybe some of the ECB commentary this morning, expectations that they'll reduce interest rates, and complaining, why isn't the Federal Reserve doing the same thing? And he ends this post with this line here, Mohamed. Powell's termination cannot come fast enough. Now, the debate we've had around the table is, how do you interpret that line? Is that someone waiting for the expiration of a term that takes place in May of next year, or someone who's thinking about doing things sooner?
So only President Trump knows what that means, but it should come as no surprise. We know that President Trump has been frustrated at the absence of interest rate cuts. I suspect he got very angry when he heard Chair Powell yesterday. Chair Powell really put all the blame on tariffs, gave no possibility to the better outcome, zero, give it zero possibility. And then there's one thing you have to remember. I know that the conventional wisdom is that this is an attack on the independence of the Fed. There is another way of looking at this, which is this Fed has sacrificed people in the past. If you remember, the president of the Dallas Fed, the president of the Boston Fed, the vice chair were sacrificed ahead of Congress looking into allegations of insider trading. If you remember, the potential side was sacrificed to protect the monetary policy side. And it wouldn't surprise me if President Trump is pushing on this, because there's a real question for Chair Powell. Should he step down to preserve the independence of the Fed? Because otherwise, the Fed will be the subject of a lot of attacks going forward.
If he did step down, would that call into question even more the independence of the Federal Reserve? What's the optimal outcome here?
So this is a judgment that has to be made, and has to be made by Chair Powell. There are credible candidates. Kevin Walsh, for example, the markets would be very comfortable with Kevin Walsh as the Fed chair. He has tremendous experience. He understands the markets. He understands economics. He has expertise. So, I could see a scenario in which what Secretary Bassett said before the election plays out, where they pre-announce Kevin as the next chair, and then that puts tremendous pressure, and then Chair Powell has to make a very difficult decision.
Let's say that happens. And I know that's not your base case right now. You can tell us if it is, but it hasn't been before. Let's say it happens, though. How do you think the market would respond to that?
So I think the market would look at Kevin Walsh and think he's a very credible Fed chair. And I think the market would rather have a credible Fed chair that's not in continuous conflict with the White House than being in continuous conflict with the White House. The Harvard example is an illustration of what can happen. You can suddenly have all sorts of other things questioned about the Fed if it's in direct conflict with the White House.
Isn't this conversation alone putting in question the independence of the Fed? You're talking about scenarios where we could basically get around the White House to placate the president.
But we've seen that. Scenarios where they've gone around the Congress to placate the Congress. We've seen a situation where, in the beginning, they sacrificed the potential side. Michael Barr was the vice chair, and he stepped down. So I don't think this is much a structural break, but I do think there's a very delicate judgment, Annmarie, here, very delicate, and I'm glad I don't have to make it.
Well, it almost sounds like you agree with the president in this sense. His termination cannot come fast enough, meaning when Powell's out of the job, it cannot be soon enough. It sounds like you agree with that.
So the word termination is a very strong word, right? That word, I must say, I looked at it and I thought, wow, that's a really strong word. But we do know that in a year's time, Chair Powell will step down. We know that. We know that he's not going for a third term. We know he's not going to get a third term. So, that issue is out there. We also know the president is really frustrated about interest rates not being cut. And I go back, yesterday's comments by Chair Powell, which he went well beyond what he's said in the past, were like a red rag to the White House.
You've been critical of the Federal Reserve before. You've referenced this address a couple of times now. What stood out for you yesterday? Where do you think the chairman went wrong?
So actually, I think the chairman yesterday was less political than he normally is. I do think that we all have to give the possibility of the good scenario. The market certainly does. You heard me say the market is 50-50 as to which of the two outcomes in the destination is going to play out. Is this going to be a Jimmy Carter moment with prolonged stagflation? Or is this going to be a Margaret Thatcher, Ronald Reagan moment where you rewire not just the domestic economies, but you rewire the global economy?
Isn't the Fed chair basically acknowledging that by saying we've got to wait for more clarity before we can decide what we need to do?
Yes, but he went much further. I mean, I have all that. He certainly said we have to wait for greater clarity, but he kept on pushing on the challenges to dual mandate. He kept on pushing that inflation may be persistent. He hasn't said that in the past. 2 meetings ago, he reintroduced transitory. 2 meetings ago, he reintroduced transitory when talking about tariffs. And then last meeting, he walked it back, and now he's gone one step further and made a very strong statement.
So let's talk about the optimal outcome. What does it look like in the months to come?
I think I am in the same boat that everybody else is, saying this is a really highly uncertain time. I think this is an uncertain journey to an uncertain destination. And the market has been swinging one way and the other. You said it this morning. Depending on the tariff news, it's either excitement or fear.
Yesterday, we did also hear Jay Powell talk out the Smoot-Hawley levies of the 1930s, 95 years ago. And he said there isn't a modern experience for how to think about this. Do you agree with him, or can you draw some modern experiences to deal with this time right now?
No, it's hard. I mean, by the way, that was a strong statement as well, something that he hasn't gone anywhere near before.
And that was the Ferris Bueller scene I was alluding to earlier.
Correct. And I remember that scene that he should have referred to in the movie. No, we haven't had this before. This is an attempt to rewire the global economy. And we haven't had this in an integrated, globalized economy.
Are you surprised by how different Powell sounds from Waller?
Yes, I do. I'm surprised how different Waller sounds from Waller a year ago.
Think he's running?
It's been quite a transformation, let's put it this way.
Do you know who did do a good job yesterday? Raghu Rajan.
Oh, he was great.
He was absolutely
superb.
Fantastic. And he asked this question, I'm pleased he asked it. He talked about the difference of a challenge to the cycle and a challenge to the system. And you and I have reflected on this too. The challenge to the system here, how are you thinking about that challenge at the moment?
So first of all, let me say Raghu was great because not only did he keep the flow going, but for those who are not very familiar with economics, he explained why he was asking the questions, and he did it really well. You know, we've put it slightly differently, is that normally advanced economies live in cyclical space and developing countries live in structural space. Now, suddenly, we have advanced economies living in structural space. So the boundaries to the cyclical fluctuations are no longer holding, or they are much wider than they were before. So you have a whole range of potential outcome. I love the United earnings call when they came out with two scenarios. It's a bimodal world. Amex today came out with a huge qualifier saying it's subject to the global macroeconomy. So companies are not only thinking internally about a range of outcomes, they're expressing it in their earnings calls.
Asset allocators need to do the same exercise. They need to work out what the future looks like. And Rajan talked about a change in US philosophy. So in the post-war system, as you know better than most, US assets are at the very heart of it. And the interpretation of this administration appears to be that their responsibilities are a net burden and not a net benefit. And they're trying to rebalance that. They look at the FX so-called distortions, that's what Stephen Myron called them, and they don't look at the benefits that come from this structural bid for US assets that deliver lower interest rates than maybe they'd otherwise get. What are the dangers of trying to rebalance that over the period of, say, 3.5 years?
So whether it is the US, whether it is the UK with the EU, this integration does two things to your balance sheet. It increases the gains and increases the potential losses. So you now operate at a higher level of both. And if you don't manage the potential losses, then people will focus on that and forget about the gains. We saw that in the UK with Brexit. So I think the more integrated economies come, the more you have to manage the downside risks. I say this because AI is really critical in this. We've got to manage the downside risk to exploit the enormous benefits that come from that.
Mohamed, you said when you look at developing economies, it's structural. And like the United States, we're cyclical. Is everyone just viewing this moment wrong? Should we be thinking about a developing economy when looking at what is going on right now in U.S. in terms of policy?
Well, some have tried to make that parallel when saying it's highly unusual to see the U.S. having higher interest rates and a weaker dollar. That happens in the developing world. That doesn't happen in advanced economies. I think that's a step too far. I think what we're seeing is a portfolio reallocation from an overweight to the U.S. to more balanced globally. That is what we're seeing. And I thought Rick Reeder yesterday on the show was great with that.
Mohamed, you're going to be sticking with us, and pleased to say we'll be talking about the Federal Reserve and the ECB, that ECB rate decision about an hour from now. Equity futures on the S&P 500 still just about positive by 0.3%, but rolling over well off session highs. That's the story in the equity market. Let's get you an update on our top stories elsewhere. Here is your Bloomberg brief. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough. Elsewhere, the president sharing on Truth Social that trade talks with Japanese officials have led to, quote, big progress. A deal has not been reached, but preparations are underway for a second round of talks later this month. And finally, Eli Lilly shares soaring after its latest weight loss pill met its efficacy goals, showing promise it could become the first approved oral GLP-1 treatment. Lilly saying trial users lost an average of 16 pounds at the highest dose. That stock is up by 13.5%. That right there is your Bloomberg brief. Up next on a program, Trump versus Powell.
People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of political or any other extraneous factors. We're never going to be influenced by any political pressure.
The political pressure is climbing. Mike Zezas of Morgan Stanley joins us next for more. Live from New York City this morning. Good morning. Krishna Gua Evercore, just nailing it. This line right here. If you like the tariff debacle in markets, you'd love the loss of Fed independence trade. Equity futures right now in the S&P. We'll let that one breathe a little bit. Positive by a third of 1%. On the Nasdaq, up by 0.5. Under surveillance this morning, Trump versus Powell.
Our independence is a matter of law. Fed independence has pretty broad support across both political parties. Generally speaking, Fed independence is very widely understood and supported in Washington, in Congress, where it really matters. People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of political or any other extraneous factors. We're never going to be influenced by any political pressure.
So here's the latest this morning. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough. Bloomberg's Tyler Kendall joins us now for the latest. Tyler, what do you make of that one?
Yeah, hey, John. Well, while President Trump has long been critical of Jerome Powell, this does appear to be an escalation. Of course, big interpretation questions, though. Is President Trump pointing to the end of Powell's term as chair in 2026, or is he threatening to fire the Fed chair altogether just one day after Powell said that the central bank would have less flexibility to cushion the economy amid tariff fallout, and also that he thinks market volatility is understandable because there's just so much uncertainty here when it comes to the tariff plans. Now, President Trump has long suggested that his tariff policy would go hand in hand, as he says, with lower interest rates. And we should keep in mind that up to this point, senior administration officials have largely brushed aside President Trump's prior criticism of Jerome Powell, saying that it's just his opinion and that they do respect the Fed's independence. But we'll have to see if we hear any stronger stances from administration officials today, particularly after Treasury Secretary Scott Bessent told Annmarie earlier this week that he thinks monetary policy is a jewel box that needs to be preserved, as he said. So really some big questions going forward. And you had mentioned earlier in the program that Bessent actually was the one that had floated the idea of potentially a shadow Fed chair on the campaign trail. Powell was asked about that back in December, 1 month before Trump took office. And he said that he didn't really think that was an option on the table, and also that he doesn't think President Trump has the legal authority to fire him. John, President Trump previously has said that he would let Powell serve out his term. But of course, big questions here in Washington about the future of independent federal regulators, particularly after last month, 2 FTC commissioners were fired, they say, without cause.
Tyler, appreciate the update. Tyler Kendall in the nation's capital. To extend the conversation, joining us now, Mike Zezas of Morgan Stanley. Mike, welcome to the programme, sir. Not the news I imagine you thought you'd wake up to. What do you make of that last line by the president? The termination can't come soon enough.
Yeah, I mean, I can't parse precisely what he might have been talking about there, but I mean, listen, I think the issue of concern here for investors is one of whether or not you feel like you own too many U.S. dollar-denominated assets. And there does appear to be kind of this rebalancing trade going on where kind of the world was overweight this, and for very natural reasons, and there's probably some risk mitigation going on here. And so to the extent you see statements like this, or maybe you're concerned with the case in front of the Supreme Court right now, challenging whether or not President Trump has the authority to fire independent agency heads, you know, all of it suggests that there might still be some rebalancing, kind of getting more to a neutral stance with regard to global U.S. dollar-dominated assets. It's the type of thing that we think can still create some near-term U.S. dollar weakness.
When it comes to this potential that this is more than just Trump waiting out Powell's term and actually he wants to do something about it, if that were to happen, what would that mean for the dollar, for treasuries as these safe haven assets?
Yeah, I mean, listen, Powell's statement yesterday about broad legal authority, broad legal protections, that seems to be the consensus, and I'm not a legal expert, but that seems to be the consensus, and it seems to be pretty stable. So any action against that would sort of raise questions. Whether or not it's succeeded, I think you introduce that question into the market. Then if you already have a basis where investors are kind of overweight or over-indexed to U.S. dollar assets, then more of this risk mitigation trade that you're seeing probably continues.
So, Mike, let me just get more clarity from you on this. You said rebalancing to a neutral stance. How far along this journey are we, and what does the destination look like?
Yeah, I mean, I don't have a precise answer to that question because I think we're still collecting fund flow data and asset allocation data. I just know we're not all the way there, right? So, again, I think this is really about what you sort of assess the probability of institutional controls breaking down are. And I wouldn't say it's our central case that we're going to have a problem with institutional independence in the U.S., but statements like these, the existence of this case in front of the Supreme Court, obviously raise the question further. And so even if you're only partway through that trade, there can be more U.S. dollar weakness without there having to be an expression from investors of a general loss of confidence.
Mike, this builds on the conversation we started having last week in a much more material way when we saw Treasury yields higher by 50 basis points and the dollar weaker. And we asked the question coming into this week, what's the alternative? Where can you find the depth, the liquidity, the predictable issuer with dependable, credible institutions around it? What is the alternative?
Yeah, I mean, let's say your near-term alternatives are the yen's the most obvious one. Euro would kind of be second there. They are insufficient alternatives to the point that you just made. But this is why I think for the moment we can avoid this kind of more existential question and look at this as more of a rebalancing trade and say there's still potentially strengths to go in those two currencies relative to the dollar.
It seems that another alternative has been gold. Gold has defied every single correlation. Risk on, gold higher. Risk off, gold higher. Weak dollar, strong dollar, gold higher. And you get a bit of profit taking, but gold continues to go from record to record. How long can this process go on?
Yeah, I mean, I don't think we have a high conviction view there. But to your point, I mean, there is this sort of whether or not you want to view it as a kind of fundamental pressure, or kind of a mix of fundamental and technical pressures, which is the way I would describe it. It is sort of a pressure that sort of leads to demand for a broad array of assets. And again, I think like the yen, the euro, those are places you might look. Is there still positive pressure going into gold? Very likely, but I wouldn't say that we have as high a conviction there.
Well, every day it seems like gold is, having this new record high. We had one just yesterday. Is that a place just to hide it out if you're unsure what to do in this moment, Mike?
I think for some investors it is. I'm sure we hear from some clients who are more sort of, true believers in this as store of value. But at this point in the debate, you don't necessarily need to pick whether or not this is just kind of a flight to safety or whether or not you have a more secular case for the breakdown of the U.S. dollar. So again, I think we're kind of in the zone of this trade right now where the uncertainty introduced by the fact that we're even having this conversation is plus the kind of, let's call it the positioning that's been heavy for U.S. dollar-denominated assets, kind of allows you to not necessarily have to choose whether or not this is a technical trade or a fundamental trade. There's just more flow in the direction away from dollars.
Mike, appreciate your view. As always, Mike Zezas there of Morgan Stanley. Gold coming up in that conversation. What a run it's had. So far, year-to-date, higher by 27%. And this rally, Mohamed, we've talked about this a few times, predates this trade tension. This has been building for quite a while.
It has, and it's gained a lot of momentum. And a lot of people have tried to fade it, only to see gold go higher and higher. I do think that central banks, foreign central banks, at the margin, are looking to diversify away from the dollar. And they're doing it slowly. And gold has been a recipient of this of flows.
Gold just pulling away from all-time highs. We're down about 0.5% this morning. Up next on the programme, we'll catch up with Alicia Reese of Wedbush, previewing Netflix earnings. Those results coming out after the closing bell. And we'll have more on these comments from the Federal Reserve, or rather at the Federal Reserve, from the President of the United States. Powell's termination cannot come fast enough. That conversation continues from New York. This is Bloomberg. Two hours away from the opening bell, equity futures positive here by 0.5%. On the Nasdaq, elevated as well, up by 0.7%. Encouraging words from the president on trade. Not so much on Chairman Powell. We'll get to that in just a moment. Some moves to look for: Taiwan Semi, TSMC, projecting confidence, keeping its growth outlook for 2025, still looking for growth in the mid 20% for the year ahead. The CEO saying demand has remained resilient. The stock is up by about 3%. I want to talk about Ford, down about a third since the high of the last summer. It's positive this morning by 0.2%, threatening to raise prices. We anticipate the need to make vehicle pricing adjustments in the future, which is expected to happen with May production. Important move from them.
I think it's an important move, and I think it's a really important signal and significant because Ford builds 80% of the autos that they sell in the United States in U.S. factories. So Ford is saying, we have to come out and raise prices because it's so uncertain and we're going to be hit with some tariffs regardless, even though we're lobbying the White House. What does that mean for the others, like GM?
That's the latest on the autos. On our radar this morning, our top story, life moving pretty fast for Fed Chair Jay Powell.
As that great Chicagoan Ferris Bueller once noted, life moves pretty fast. For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance.
It's moving fast this morning. President Trump with these remarks, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough.
Big question if he means the termination, the end of his term, May 26th, or the termination like he's going to do something about it. So I think we're waiting on some clarity. We have to, depending on what the president, I'm sure he's going to be asked about this today. Neil Dutta nailed it yesterday. He probably picked up on what Powell was talking about when it comes to tariffs, how he kept coming back to tariffs, how it's on the high end of the Fed analysis, and quote tweeted a Trump tweet from 2019 where Trump said, my only question is who is our bigger enemy, Jay Powell or Chairman Xi? And he wrote coming soon, question mark, meaning is Trump going to come into this fight and push back on Jay Powell? Well, he did this morning.
We mentioned this note from Krishna Gua over at Evercore, so let's go back to that note. If you like the tariff debacle in markets, you'd love the loss of Fed independence trade. Mohamed, can you just reflect on that a little bit? What would that look like if we did lose faith, confidence in Federal Reserve independence?
I want to say if, because I'm looking at the bond market right now, it hasn't moved. It has not moved. Yields were up 2 to 3 basis points. Yields are up 2 to 3 basis points. So the bond market has completely brushed aside this issue. But if, I say if, the people will go back to the 70s and will remember what happened then, and there would be much bigger inflation premium in markets across the board. But I want to say if, because with the exception of the word termination, which is a very strong word,
true,
nothing is surprising in that post.
We've said it repeatedly this morning, it's difficult to know how to interpret that word. Is that word basically referring to the fact that his term expires in May next year, or does it mean he's willing to go much further, do something far more drastic?
And I think that ambiguity is purposeful. I think the president is trying to have this debate and maybe have individuals that are renowned, like Mohamed El-Erian, come on and say, actually, maybe for the best of Fed independence, maybe Jay Powell should even consider stepping down. He is starting a debate now by just the use of this one word, and I think he knows what he's doing.
Well, let's explore the if. Let's explore that a little bit further. How do you think the international community, international investors would view that move? How would they treat treasuries and dollar-denominated assets if that happened?
What is the if? The if is really important.
If they fired him.
Without announcing the replacement immediately, who is credible like a Kevin Walsh?
Oh, you think the replacement's just as important here?
Oh, absolutely. You cannot replace something with nothing. Britain learned this during Brexit. We're learning this during the tariff thing, is if you don't have something credible to replace what you are bringing down.
But to extend it, Mohamed, because this is important, once you've fired one, it would open the possibility that the next one could be fired too, which opens the idea that they're just going to do whatever the president would like them to do. I think that's the issue really at play here.
It is, but it's the counterfactual. What if the Fed ends up in a Harvard situation, whereby every day there's a new attack coming from a different angle? So this is why I say this is a really difficult judgment. You've got to sort of guess what the counterfactual is likely to be, and then decide if your objective, which all our objectives should be to preserve the independence and integrity of the Fed, what's the better outcome?
Yeah, but the precedent this sets could be catastrophic. To John's point, it could be a domino effect where every single person can maybe get fired. True.
Alternatively, they could find different ways of eroding permanently and structurally the independence of the Fed. So this is a really uncertain time.
But to the rest of the world, doesn't it just look like the Fed chair now just does the president's bidding, and then we look like Russia or any other economy where there's that relationship?
That is certainly the risk. And I'm just saying, I said during the break, I love this quote from Justin Fox, that uncertainty has never felt this uncertain. And that's the world we're living in, sort of uncertainty being even more uncertain than uncertainty normally is.
It's what the last couple of weeks has felt like, that's for sure. This story is going to dominate the conversation this morning, no doubt. I just wanted to fit this in as well, that the president's also saying his administration made, quote, big progress on talks with the Japanese so far this week. The lead negotiator saying preparations are underway for a second round of talks later this month.
So these talks with the Japanese are being closely watched. It's been insinuated by the administration they could be one of these first countries to get a deal. Scott Bessent told me the first mover advantage is going to be that individual. Well, it does feel like they have the first mover advantage. They're the only ones that have gotten a sit-down with the president himself. But no deal yet, Jonathan. They still have another negotiation to go through. My question is, they only have 90 days. We're talking about July 8th, just after July 4th and that holiday weekend. Can they get even a dozen of these deals done? Usually trade deals take years to hammer out.
Clock is ticking, and certain companies are stuck between a rock and a hard place. The Infinity CEO, Jensen Huang, visiting Beijing at the invitation of the China Council for the Promotion of International Trade. His visit coming as Trump administration slaps China export curbs on Nvidia's H20 chip in the last 24 hours. Mohamed, we've had this conversation in the past. Choosing between one and the other. You wrote a piece a number of years ago. I forget the precise phrase you used, but it was the so-called fence-sitters. Certain countries that wanted the trade relationship with China but wanted the security umbrella from the United States. How sustainable is that now?
It is much less sustainable and it's much more expensive. I called it the dual option model, that you have an option on the US for national security, you have an option on China for economic prosperity, and the cost of that option was extremely low. Now the cost of that option is going up, and most countries are terrified of having to make a choice between the two. Some countries will remain swing states. Brazil, India, Saudi Arabia, UAE, they have something special that allows them to be swing states, that allows them to maintain that dual option at a low price. But others, Philippines, Japan, etc., will find it much harder.
When it comes to things like chips, though, you see the Trump administration doubling down even further than the Biden administration did when it comes to these export control and chips. This H20 was produced and manufactured just so they could go to China. But you're going to find bipartisan support for things like this. De-risking from China, making sure they don't have access to high technology. But I have to think, with Jensen Huang going over to Beijing, this feels like Tim Cook and what he does and goes over to Beijing. And when China comes out and says, we want a point person for trade, I wonder if it's these diplomats, these corporate executives.
You've got to think about what she's doing. And yes, corporate America have been great diplomats for the objectives of the Chinese over the last few years, and that's a very separate story. And the administration, quite rightly, has been unhappy with them on that front repeatedly. The Chinese are also doing their own diplomacy. She's been visiting various countries, speaking to various nations, Malaysia, Vietnam in the last week. Mohamed, as you know, this president would like our trading partners, allies, the likes of the Europeans, to put the walls up for the Chinese. They'd like the Vietnamese to do the same. Do you think that's possible in the year to come?
It is possible. I mean, there's two big games of chicken going on right now. One we've already talked about, the administration versus the Fed, and the other one's US versus China. And US versus China visibly is a tariff. Behind the scenes, it's trying to get a coalition of countries against the other country. So you've seen this in China. They are doing a lot of diplomacy, quiet diplomacy, trying to say, we are the reliable, we are the dependable superpower here. Let's have more trade links. Let's talk about payments links. And then you have the US saying, let's unite all these countries, starting with the 17 we're talking to now, not only to ensure low tariffs, but to ensure that they put tariffs on China as a way to protect themselves from Chinese dumping. So it's fascinating to me that you have a very visible war going on, tariffs, and then you have a less visible war going on, which is for the other countries.
The Europeans certainly stuck in the middle here because they'd have to eat the overcapacity coming out of China if the wars stay up here in the United States. More on the ECB later on. That decision is about 35 minutes away from the European Central Bank. We need to talk about earnings later as well. Netflix reporting earnings after the closing bell, with analysts expecting it to weather the macroeconomic climate better than competitors. Alicia Reese of Wedbush writing, while massive subscriber growth was the primary driver in 2024, we expect price increases to drive revenue growth in 25, and the ad tier here to drive revenue higher in 2026. Alicia joins us now for more. Alicia, welcome to the programme. There is some pressure on consumers. Sentiment is absolutely cratered. Alicia, as we saw in retail sales, though, they are still spending. But some of that spending is about fears of higher prices in the future. What do you think this will mean for discretionary growth on things like Netflix?
Well, I think for now, the key driver is content. There certainly comes a time where people will cull their budgets and stay home, skip a vacation, maybe buy a few less new items. And what they'll do instead is stay home and watch content on Netflix and other streaming services. And so whoever has the best content gets the most eyeballs, and whoever gets the most eyeballs can get the most advertising dollars. Netflix doesn't have a lot of people yet on their advertising tier, but they're certainly trying to grow that, and they will over time. But still, this year, they are not going to give subscriber numbers. And what they're going to do instead of giving subscriber numbers is, they increase their tier pricing. And so they're going to be able to give quite a bit of revenue growth still.
I understand.
On top of that, and it's going to be really positive for them.
Alicia, I understand people may stay home if they're worried about going out and spending in this time of uncertainty and tariffs and potentially prices going up. But advertisers, are they going to have the money in this uncertain environment to want to spend?
They're certainly going to cull their budgets and pull back pretty significantly. So they have to be more accurate. So they're going to want to move a lot of advertising dollars from linear TV that is less targeted to connected TV that is highly targeted, on par with or better than social media targeting. Connected TV has significantly more targeting capabilities, and that's really where the eyeballs are, especially in an environment where, people are staying home a bit more. And as sports continue to shift towards connected TV from linear channels. So, advertisers are just going to be a little pickier about where they put their dollars, and they know people are on Netflix. So that should insulate Netflix to a degree.
So, Alicia, I hear you say that we're going to get an acceleration of a secular move. So how does linear TV respond?
So linear TV has to keep sports as much as possible. What Disney's doing is taking ESPN and just creating a lot of different outlets for it. And
I think we lost that connection there with Alicia Reese of Wedbush, looking ahead to Netflix earnings after the closing bout. Exciting stuff, Annmarie.
Exciting
a bit
stuff,
later.
I guess, when it comes to sporting and whether or not you get that on Netflix. I've been thinking about this when it comes to Netflix earnings because the Wall Street Journal recently had a piece saying that they aim for $1 trillion market capitalization. How do you do that at a time when people are uncertain? Are they going to be spending more? If you don't already have a Netflix subscription, why are you going to sign up now when you see poll after survey that people might be holding back?
How many zombie accounts do they have? Just people who are signed up, still paying, but never watch the thing?
Oh, I don't know about that.
I asked that question because I'm one of them. I've got one of those zombie accounts.
Well, how many people are some of those password cheaters? Because I'm one of them.
I know you're one of those too. They're clamping down on that, as you know.
I'm stunned between the two of you.
I want to know what Netflix version of White Lotus is. What's their hot new... Are you watching anything?
Someone else can tell you that.
I am, but why don't you take his account, which he's not using, and you don't have to see... I mean...
You're right.
What, and I keep paying? Yeah. No, Mohamed, that doesn't make sense.
You're paying anyway.
No, and the first thing that will go when things really start to bite is the Netflix account, which is why I ask how many zombie accounts are out there.
There's probably a bunch, I imagine.
I think a lot of people just have accounts and don't watch anything. Anyway, let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief. Goldman Sachs looking at the worst-case scenario for US and China decoupling. US investors may be forced to sell around $800 billion of Chinese equities, and Chinese investors might need to offload $1.7 trillion of US financial assets. Elsewhere, New York Congresswoman Elise Stefanik is weighing a run for governor in her home state. Stefanik's allies confirming her interest in the race, with the Republican lawmaker increasingly outspoken in recent weeks with criticism of Governor Kathy Hochul. And finally in sports, the Champions League semi-final matchups are set. Arsenal taking on PSG after besting Real Madrid to reach their farthest in the tournament since 2009. Elsewhere, Barcelona facing Inter Milan, the next round kicking off on April 29th. And that right there is your Bloomberg brief. Up next, a hawkish Chair Powell.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation.
That explanation up next. We'll catch up with John Boivin of Blackrock. Equity futures just about positive this morning. We're up by 0.4% on the S&P, on the Nasdaq higher by 0.7. Under surveillance this morning, a hawkish Chair Powell.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. Markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation. Markets are doing what they're supposed to do.
So here's the latest this morning. Stocks are heading for a week of losses as Fed Chair Jay Powell pours freezing cold water over the so-called Fed put. Joining us now to discuss is Jean Boivin of Blackrock. Jean, good to see you, sir. Some reaction by the President of the United States earlier on this morning, which I'm sure you saw, complaining that the chairman had not cut interest rates, unlike the ECB, which is set to do in about 30 minutes' time, and saying at the end of his social media post this morning that Powell's termination cannot come fast enough. If clients asked you about that line this morning, what will you tell them?
Well, I spent a week in Europe last week, and I'm going to tell you that the discussion about like U.S. asset and how we should think about this environment is totally different than everything I've seen. And I think that kind of development in the context that is already one that investors are shaky, I think will require quite a bit of work to reassure. I think what I would say I would fall back to. I think there are immutable laws that are at play here. We're going to be bumping into them. We need to be ready for some chaos along the way, but we're going to be bumping into some pretty immutable laws, and I think that's what we need to get a handle on.
We've said repeatedly on this programme this morning that we'd like clarity from the White House what termination actually means. Does it mean the expiration of the term, May next year, set to take place, or moving that forward and doing something more dramatic? But you've touched on something important. The erosion of trust in US assets that we've seen. Some people have made the case that over the last week, all we saw was Treasury markets responding to the unwinding of trade, some hedge funds blowing up, and maybe it was nothing bigger than that. What do you think it was?
I think there's a broad story here, and if I had to say one word, I think it's debt. It's the large U.S. debt that is a big part of the story here. But I think what we've seen, we were of the view, we've discussed that before, that we were in an environment shaped by supply. I think the tariff discussion we're having here is very much an example of another supply shock that is leading Chairman Powell to be more hawkish than people expected, I guess. But there is a really real story of a supply shock that is putting pressure on rates to go up. So I think there was already pressure for long-term rates to go up. But you add on top of that, questions about tariffs that are really like, if you really are trying to decouple from the rest of the world quickly, that also means that you're cutting yourself out from a source of funding for your debt. And the debt is large, and I think this is the key thing that is driving here is that the financiers of that debt, the people financing it, are looking at this differently now. And I think that's adding another kind of risk premium, if you will, in terms of long-term rates. And so that is the dynamic at play. It's not about one player. It's not about one official government selling or not. I think this is a broader kind of sentiment story.
So, Jean, you told us about what you heard. You told us about the sentiment. How far are we in this rebalancing from the U.S. to the rest of the world?
I think we're pretty far. I mean, if the real intent of reducing current account deficit and surpluses and balancing these things, we're very far from that objective and decoupling. And in fact, I don't think that can happen very quickly. So to me, this is more that there's a very near-term kind of immutable kind of constraint that we're going to be bumping against, as I said before. And it's going to be materializing by rates going up, which will make the debt look very different for the government, I think, themselves. I think the biggest challenge for them is rates at 5% in 10-year changes completely the budget arithmetic going forward. And I think that will have to be confronted at some point. So that's why, I mean, no matter the intent, I think we're going to be stopped along the way. It's a many years process as opposed to a many months process.
And that goes against a key objective from this administration, which is to keep rates much lower. They want to see it going lower to 4%. When it comes to things like who is dumping these assets, the Treasury Secretary didn't seem to think it was foreign governments. Do you think it's sovereigns?
As I said, I think this is a broader global reassessment and thinking. I think there is broad fundamental reasons for rates to go up, and then you get events like we got last week, and it adds to this narrative. So I think it's difficult to pinpoint like a single source. I think this is broader. And then when these things happen, there's always other things that happen at the same time. So you get like the dynamic deleveraging in the market that gets triggered by this. So I don't think we'll ever pinpoint one, but I think we should take note that there is a sentiment story that is playing out.
So, John, one of the things that is really debated right now among global macroeconomists is what is the beta of the rest of the world to U.S. growth? So some people feel that it's 0.5, others feel it's more than 1. Where would you put the beta, the growth beta of the rest of the world relative to the US for Europe and for developing countries?
I think there's a distinction between where this administration might want to go in many years from now and where we are right now. I don't think the world has changed materially yet. I mean, yes, the tone and everything has changed like drastically, and the uncertainty is as uncertain as we've ever seen it, as you said before. But right now, the fundamentals, where the U.S. is still very much as linked as it was, and I think we've seen it, right? When we've seen Liberation Day, we've seen the U.S. market tank. It's not like Europe has outperformed during those days or other markets. So the beta is still very much as strong as it was. Over time, it might change.
More than 1 or less than 1?
I think we're looking at something that looks like 1 right now. So I don't think I wouldn't take a big bet on either side, but I think it looks like it's very much correlated with.
Does that mean you can't take as big a bet for Europe against the United States and vice versa, if they're all in the same boat?
Yeah, so I think it's tempting to say U.S. is risky, so let's go elsewhere. But because of that beta, I think we're still in a world where all boats will be moving together. But there is one thing happening, though, is that in this environment, clients have always been having a home bias, right? It's easier to invest closer to home. I think that exacerbates that home bias that we have. So it's in this environment.
Your high conviction view is actually in the Treasury market. So shall we finish on that? Underweight Treasuries. Is it for all the reasons we've discussed or something missing?
It's for, well, we had on top of that the inflation story that is not resolved. It's actually being, fueled somewhat more with those measures. So we have been underweight U.S. Treasury. This is the highest conviction we've been having for the last many months, even I would say many years. We're resetting to a higher rate environment. Everything we see confirms that, and the latest development, I think, add to that as well.
And the latest communication from Chairman Powell would reinforce it too. Boivin of Blackrock. This Federal Reserve not in a rush to do anything anytime soon.
Rates on hold, quote, for the time being. It seemed like Chair Powell was not in a rush to even give the market a little bit of a Powell put, saying we're going to step in. He was leaning on the fact that the inflation story, they just don't know yet. Looking at the survey data, they just don't know how these tariffs are going to complicate price pressures.
The President of the United States watching the ECB of all things this morning. The European Central Bank set to cut interest rates in about 20 minutes' time. Widely expected to anyway. The President unhappy that the Chairman of the Federal Reserve is not considering doing the same thing. Big hour coming up. An ECB news conference just around the corner. Decision 20 minutes away. And we get some data at 8:30 Eastern time when we have jobless claims in America. Up next on the programme, Alex Altmann of Barclays, Bloomberg's Lizzie Burden, Pooja Kumra of TD and Lauren Goodwin of New York Life. And Mohamed sticking with us for another 60 minutes.
There is real damage happening today, right now.
There's a lot of bad sentiment, and that's helped the market recover.
People are looking for some amount of clarity.
Markets are very jumpy and very uncertain these days.
The appetite for U.S. assets could be something that is a question.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures positive on the week so far, heading towards a week of losses. On the S&P at the moment, high by 0.5%, attempting to take a bite out of this weekly loss. The Nasdaq up by 0.8%. As the president says, talks are going well. We're making big progress with the Japanese. That's opening the door maybe to a trade deal before this 90-day pause expires. Coming up later on this morning, this hour, 8:30 Eastern time, jobless claims just around the corner. Before we get there, an ECB rate decision, then a news conference 30 minutes later at 8:45. The president watching the ECB rate decision, unhappy that the ECB is expected to cut interest rates and this Federal Reserve isn't set to cut anytime soon. Complaining about the Fed chair and saying this at the very end, Powell's termination can't come fast enough.
A rare applause from the president when it comes to Europe and the ECB. a dose of uncertainty he throws in about the independence of the Fed using the term termination. We need some clarity from this White House. Is the president talking about May of 2026 when Powell's term is up, or is he talking about actually trying to oust the Fed chair?
Based on the market reaction this morning, I'd say that most people are saying it's the former and not the latter. Mohamed, futures up, bond yields not doing much. We've barely blinked in the face of that statement.
Right. As I said, I don't think anything is surprising other than the word termination in that statement.
I've been surprised by a lot over the last 2 weeks.
That's true. We don't know. I will say the Secretary, Scott Bessent, Treasury Secretary, said to me earlier in the this week, I believe that monetary policy is a jewel box that has got to be preserved. There is context that you brought up earlier, Jonathan, that's really important to this moment. It's the fact that we do have two top officials that were ousted from independent agencies, and the Supreme Court came out and said, at this moment, we're going to let the president do that. And that is why investors have been concerned about the independence of the Fed. Can the president do what he did say to the FTC?
The ECB decision about 13 minutes away. Coming up this hour, we'll catch up with Alex Altmann of Barclays as stocks look to snap a two-day losing streak. We'll speak to Pooja Kumra of TD Securities, reacting to the ECB rate decision, and Lauren Goodwin of New York Life on why it's a vital time to reconsider asset allocation. We begin this hour with stocks higher on rising optimism over trade talks. Alex Altmann of Barclays writing, investors are very much at the mercy of the policy path of President Trump. And with that heightened uncertainty, the opportunity set to run a large portfolio inevitably shrinks. Alex joins us now for more. Alex, good morning. Good to see you.
Good morning. Good to see you.
Better time since we last spoke.
Marginally.
Have things settled down from your standpoint?
In some ways they have, and in some ways they have not. Of course, we can think about the fact that the level of markets is lower than where we last spoke. But at the same time, volatility's also come off the ball a little bit. And so I think the key message, though, is what's happening in the bond market. Has that sort of began to stabilise from last week's jitters? And at the margin, I would say yes, but we're very much still on tenterhooks.
Stability this morning and certainly this week, jitters last week. What did you think the jitters were about?
It wasn't one specific thing. It was a multitude of things. So, of course, people were pointing at foreign selling of it. And then there was a specific focus on, say, the fast money community and the levered community that had, like, whether it was bond basis trades or SLR relief trades on the swap spreads. But in truth, it wasn't one specific thing. We actually hosted a large call with our US rate strategy yesterday just to examine and do a deconstruction of this point. And what we found is that it was a combination of both technical and fundamental factors, and including, let's not move away from the fact that this decline in US exceptionalism, which obviously we discussed last time as well.
So, Alex, you used the word marginally in responding to John's, it's a better time. Drill in a bit marginally. What are you looking for?
Well, so what our big focus has been is uncertainty. Right, so uncertainty for us is really, especially within equities, is a compression of the multiple. And so what we think has happened within the US equity market, really year to date, is just priced in that uncertainty. But we haven't priced in really a recession. We haven't priced in a meaningful decline in earnings. So what we're looking for is either removal of that uncertainty, which will obviously drive, I think, equity markets back up. I don't think they're going to go back to all-time highs in the near term, and that's just because we're still dealing with an administration that could be perceived as quite volatile. But at the same time, we haven't seen that precipitous drop in the economic data as well, which would drive the S&P down to some of the more bearish targets that we're seeing.
So give us your probability distribution between a good removal of uncertainty and a bad removal of uncertainty.
Right now, I would say that we're leaning more towards the bad removal.
By how much?
In terms of the S&P levels.
Yeah.
So I think that if you start to look at, say, a 2022 analog where we didn't actually have a recession, but the market was quite vehement in pricing one in, we troughed it around about 15 to 16 times. If you put that on, say, an unadjusted earnings of, say, call it 255 or 260, which is still growing year on year, just might I add. That's down a lot from where we were, say, at the beginning of the year in the 270s for the S&P. Then we're looking at probably still around about between 4,000 and 4,200 in the S&P.
When you say uncertainty, do you mean tariff policy?
I mean tariff policy, but we've also discussed other aspects of uncertainty, whether it's monetary policy as well. And indeed, I think we've also got to put on the table geopolitical uncertainty as well. We've got to think about what's happening with Iran. We also have to put on the table as well, potentially, if there is an escalation with China that moves beyond just tariffs into more economic warfare, or dare I say even kinetic. And I think that's something that's very hard to discount, but nonetheless, it's something which, again, if we're going to put within the realm of possibilities, you have to put everything on the table.
Hearing from the president again this morning, saying I had a very productive call with the president of Mexico just yesterday. Likewise, I met with the highest level Japanese trade representatives. It was a very productive meeting. Every nation, China, wants to meet. Today, Italy. Is there any evidence that China wants to meet?
Not at this moment. I think what China has put out, and this is also through a Bloomberg scoop, this is based on our reporting, is they put out a number of parameters they want the administration to meet before they're even willing to have these conversations. That means reining in some of the hot rhetoric we've heard from cabinet ministers, and also for the president to appoint a point person, put someone in charge of these negotiations.
I know this is frustrating, trying to read the tea leaves of all the communication coming from the White House, but it's interesting. When the president says China wants to meet, and there's no evidence of it, I think maybe spend less time questioning that and question why he's saying it when there's no evidence of it. Because I remember in the first term, and I always repeat this story, when markets were in a pretty volatile period and the president came out and said, just had a call with China, and there was no evidence of the call ever taking place. But the real point was that he said, I've just had a call with China, which gave you the impression he was worried about how investors were responding to the news. Do you think it's important that we're hearing more about negotiations and exemptions and less about punishment of allies?
I think it's very important because at the margin it's telling us two things, one of which I think you've answered, which is when as much as they say we're not looking at markets, they are looking at markets. And I think last week's bond wobbles was evidence of that. And then, sorry.
I was going to say the president's doing two things at once. He's talking down the market, potentially, talking about the termination of Fed Chair Jay Powell. He's talking up the market about all these calls, the negotiations, and how he's personally involved. Do you think we're at peak uncertainty? The Treasury Secretary told me he thinks the VIX has peaked. Do you think that's true?
I think that the VIX is not really a reflection of uncertainty. I think the VIX is a reflection of many things within the equity market and a function of skew and obviously volatility and whatnot. Do I think we're at peak uncertainty? We may be close to peak uncertainty, but I think you've got to delineate that from, are we at peak, say, negativity? And that's not necessarily the same thing. And that's kind of back to my point in terms of, I think the S&P, or just US markets in general, have done a lot to reflect the fact we're in a new regime of uncertainty. But it definitely has not done all the heavy lifting to reflect all that negativity.
So you're worried about the downside to US equities. If I listened to you and I sold some of my US equities, where would I go?
So this has been obviously the question all year is where do you go? I think there's a couple of things you have to keep in consideration. First of all is the opportunity set. So you have to go where there is genuine valuation opportunities, and that is not necessarily that obvious. We've had a kind of an everything rally for a long period of time. However, there are pockets, and this is something which we discussed last time. For example, some of the LATAM countries are actually behaving incredibly well. You've also got to think about the fact, I mentioned Mexico last time on this panel, and Mexico is a very interesting beneficiary, I think, of what's happening with regard to potential sort of protracted trade war with China. But on top of that, I think we've got to look back again at pockets of Europe as well. For example, Europe trades on 13 times, not particularly cheap, but at the same time, it is embarking upon a fiscal expansion process. And so if you compare that to the US on 21 times, which is going through, at the moment, fiscal neutrality or even fiscal contraction, then you have to sort of start weighing up the odds of, okay, where do I want to be? The other point, though, is liquidity. The biggest challenge for investors right now, this is back to the fact that the opportunity set, it shrinks just simply because the US still represents the best part of 2/3 of global market capitalization.
So the first part of your answer, I hear keep your equity beta where it is, just reallocate from the US to the rest of the world. The second bit of your answer is reduce your beta, your equity beta. Which is it?
I think you reduce equity beta. I don't think it's a prudent place to be in US equities when they're on this valuation with this level of uncertainty. And I think that we have to consider the reality that the longer that this tariff uncertainty goes on, the more damage it's going to do to the economy. If it's resolved quickly, then great. But I think that if we're in it for the long haul, then we have to accept the fact there will be implications to the economy.
Alex, appreciate your time.
Great
breakdown. Thank you, sir. Alex Altmann there of Barclays on the latest. An ECB rate decision just around the corner. That drops in about 5 minutes' time, 8:30 Eastern time. You'll get jobless claims. And then at 8:45, so in about 40 minutes from now, you'll hear from the President of the ECB, Christine Lagarde. Let's give an update on stories elsewhere this morning. Here is your Bloomberg brief. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest interest rates, adding that Powell's termination cannot come fast enough. Elsewhere, Taiwan Semi reporting better than expected quarterly sales and maintaining its revenue growth outlook despite tariff risks. The chip maker stressing demand has remained resilient and expects AI revenue to double. And finally, the LVMH CEO, Bernard Arnault, saying the luxury group's demand trends are worsening as aspirational shoppers cut back more than higher-end consumers. Arnault adding tariff talks are also weighing on the outlook. That stock is down just a touch this morning by 0.1%. Up next on the programme, we'll catch up with Pooja Kumra of TD Bank with an ECB rate decision just around the corner, and we'll head over to Frankfurt, Germany to catch up with Bloomberg's Lizzie Burden from New York City. You're watching Bloomberg TV. ECB rate decision about 60 seconds away, so look out for that. In just a moment, we'll head over to Frankfurt, Germany and catch up with Bloomberg's Lizzie Burden. Equity futures going into it just about positive on the S&P by 0.5%. On the Nasdaq 100 up by 0.75%. The headline coming from the President of the United States is that Chairman Powell's termination can't come soon enough. Had a bunch of messages from terminal subscribers looking through this, seeing it as noise. And you see that reflected in the bond market. Mohamed, you were talking about this too. Bond market's hardly moved. Yields are higher by 3 basis points. If you really thought that the independence of the central bank, the Federal Reserve, was about to collapse, I imagine you'd be picturing different moves in the bond market this morning.
Oh, totally. You'd see yields higher. You'd have a different reaction, and you would see a lot more disorderly volatility. But you're not seeing that.
Certainly don't have that right now. Annmarie, we're going to be waiting for that clarity that comes from the White House. What did he mean by that? What is he talking about? Terminating him or just waiting for the expiration of his term?
We're either going to have to wait for Caroline Leavitt, or at some point if the press sees the president today, which I'm sure they will as he greets Giorgia Meloni, they're going to want to know, did you mean the end of May 2026 or do you plan to oust him?
This comes from the ECB. We're getting that cut to interest rates, as expected, 25 basis points. The deposit rate drops to 2.25 from 2.50. The estimate was 2.25. A range of headlines coming from the ECB, not pre-committing to a particular rate path. This is something we've heard repeatedly from the Governing Council and the Central Bank President, Christine Lagarde, not pre-committing. And how can you pre-commit when you don't know what the policy is going to look like elsewhere in the months to come? Joining us now to break this down is Lizzie Burden, live from Frankfurt, Germany. Lizzie, welcome to the programme. What do you make of the early headlines as they cross the Bloomberg?
Well, John, Donald Trump made this decision pretty much a no-brainer for the ECB, didn't he, with his tariffs, because the expectation is that they're going to weigh on euro area inflation and on growth. And we haven't seen a retaliation from the EU yet, so they haven't had to deal with the potentially inflationary impact of that retaliation. So given this was well priced, words are more important than actions today. And I'm waiting to see whether they drop this language about monetary policy becoming meaningfully less restrictive, because they added that at the last meeting. Dropping it would be a hawkish signal. And if they drop it, it would signal that maybe there won't be more cuts to come. So we just wait for that now. At the moment, traders have been pricing a 70% chance of a June cut. If Christine Lagarde at this press conference really goes to town on just how bad the growth hit is going to be, you could see traders thinking about a 50 basis point cut when it comes to that June meeting. But I also wonder, how much is she going to address euro-dollar strength head on? Because, of course, it makes imports to the euro area cheaper, disinflationary. It makes exports out of the euro area more expensive, supporting that case to buttress growth.
Yep.
And traders are really going to be listening in for this, because today's been such a volatile day for the euro. I think it's the second most volatile on an ECB day ever in history.
Lizzie, you wanted that headline. It just crossed the Bloomberg terminal. They've dropped that word restrictive from the decision statement. I've got the statement in front of me. I just wanted to share this quote with you as well. On trade, the Eurozone economy has been building up some resilience against global shocks, but the outlook for growth has deteriorated owing to rising trade tensions. Increased uncertainty is likely to reduce confidence among households and firms, and the adverse and volatile market response to the trade tensions is likely to have a tightening impact on financial conditions. These factors may further weigh on the economic outlook for the euro area. Lizzie, what we've seen from a range of officials and from companies, particularly on this side of the Atlantic, is offering dual scenarios. Do you think that's something the ECB president could lean into in the news conference in the next 30 minutes?
I think the fact that they've kept the language about going meeting by meeting and data dependent shows, of course, that they want to hedge their bets at this point, keep their options open, not commit to a particular rate path, because in an environment like this, John, they just don't know what lies ahead, do they? If you think about how much pressure there is on Christine Lagarde today, she's got to try and calm markets, though, because we haven't got a BOE decision this month, we haven't got a Fed decision this month, and you heard Jay Powell last night basically, of course, saying that you can't rely on the Fed for the Fed put. So it's a huge job for her at this press conference to calm them, but I am shocked that they have dropped that language at this meeting.
Lizzie, appreciate the input. Lizzie Burden there, Bloomberg's very own. Look out for Christine Lagarde a little bit later on this morning, 8:45 Eastern time, so in the next 30 minutes or so. If you are just joining us, the ECB reducing interest rates by 25 basis points on the deposit rate, widely expected. The rate was 250, it's now 225. Joining us now to discuss, Pooja Kumra of TD Securities. Pooja, welcome to the programme. I'm sure you've gone over the statement very quickly. What do you make of this decision?
As you said, I'm also surprised that they removed the word restrictive, but we also note that they have downgraded the growth forecast. They are worried about growth. And I think that was maybe a balancing act between, satisfying both the doves and the hawks. And I think we and markets know that in case of Fed, we have a challenge for upward risk to inflation and downward risk to growth. But when it comes to ECB, we have a downward risk to growth and inflation. If you look at the move in euro dollar, you look at the move in oil prices, you look at the move in financial conditions, ECB is going to be below its inflation target than what they had expected in March. And I think that's very much obvious. And I don't think that ECB can actually turn their eyes with respect to that. And also when it comes to the general policy, they have told us 1.75 to 2.25 is kind of their neutral range. But I think when we think about neutral, we should also think about the circumstances behind that. And if things continue to deteriorate, especially what we saw last week, I think ECB has no choice but to continue with this series of rate cuts.
So, Pooja, they are acknowledging that the financial markets, financial conditions are doing the tightening for them, which is maybe something they've got to lean against. And there's also the prospect, I would say, of them and the continent needing to eat overcapacity out of China, which could be a big, big disinflationary problem down the road. Do you think that's the focus now? Do you think that should be the key risk that they focus on in the year ahead?
Yes, certainly. They have to find a mid-path between how to deal with the US as well as with China. And I think both ways, Europe is getting squeezed right now. The issue is that, does this retaliation turns up into negotiations? So far, when it comes to Europe, we have seen that they do not want to retaliate against Europe. And with respect to China, they're really not telling us any stance. I think at this stage, ECB, especially when as EU is concerned, they like a slower approach. So I think they are just trying to see how US and China evolves in the coming weeks. But I think they have just bought themselves time. In June, we will have the updated forecast, and which will show us a very grim picture if this uncertainty continues.
Pooja, take us inside the Governing Council. How wide do you think the range of views is?
So even, ahead of the Liberation Day, not everyone was expecting an April rate cut, right? We know that there are lots of ECB members that now are getting very careful as to how much they want to cut rates. So there is a lot of disagreement when it comes to this decision. But I think right now, even when you see the risk to the growth, Christine Lagarde herself has mentioned that a 25% tariffs in total could actually mean up to 1% hit to growth. And I think in that case, both doves and hawks will have to agree to the fact that they will need to cut rates. But I think a more effective tool here will be more from the fiscal side, i.e. we see more loan programs from EU, or ECB doing another TLTRO or loan targeted program for banks. I think that is more of an effective way of actually supporting all the companies that will be getting hit by this additional tax, which is the tariff tax.
So, Pooja, you raised the issue of other policies which would be much more effective than the ECB. The ECB could end up pushing on a string yet again. How risky is it that other policymakers in Europe will slip back into the ECB is the only game in town, let the ECB do all the heavy lifting?
I think everyone expects it's a central bank that needs to do the heavy lifting. And same for the case of Fed. Everyone thinks that Fed will have to actually support the economy ultimately. I think they will need to find a balance here. For me, the key for ECB is how we stand on the financial conditions, because, last week we actually thought that this is, when you saw the movement in credit spread widening, it's hard for ECB to ignore all these things, even if the hawks think that inflation is not in the right path. Because, what we are doing is the supply side and demand side both are getting hit with this entire shock. So I know ECB will be the key player of how things evolve. If they don't, the financial markets will force them to. But I think ultimately the key solution to target this issue will be a proper targeted support to these companies that will actually get the effect from the tariffs.
Pooja, I know people think that it's a joke, but in all seriousness, is the President of the United States basically deciding monetary policy over in Europe?
Unfortunately, not directly, but we can say indirectly, yes, right? The hit to growth, inflation, financial conditions, like whatever you talk about, it's got hit after the Liberation Day.
Pooja, we've got to leave it there. Thanks for dropping by. Important conversation. Pooja Kumra there of TD Securities nailed it. Last time the ECB met, we thought maybe they'd go on pause.
Yep.
We didn't know when the next interest rate reduction was coming or if it would come at all this year. I think people thought it might come maybe later on in the summer. Here we are now. This has changed, Mohamed, because of one reason. The announcement on trade on April 2nd.
It has. But, John, let me ask you a question. I can't remember the last time a federal official referred to the ECB. Can you remember any case of a US president referring to the ECB?
This is new territory.
Yeah.
Without a doubt.
What's so interesting is the president really wants the Fed to cut, but his policies has made it easier for the ECB to cut, which is the point he's making this morning.
And this is going to be the confusion. So if you're sitting here watching this programme right now and you're thinking, well, why is the ECB cutting in response to this? Why isn't the Federal Reserve? And I think the explanation is quite simple. The chairman at the moment is worried about the price effect. The ECB has to face something very, very different. And this is something we touched on in that conversation there. If the walls go up in the United States and you've got this overcapacity issue from China, and China exports all of that, and they only have one major destination to export it to, and it's not the US anymore, Europe has to eat it. The price pressures, the risks in Europe are way, way different versus the United States. You've got upside risk to inflation in the United States. I would say off the back of this, you've got downside risk to inflation in Europe, surely.
Yeah, but that's the wrong response, okay? If you're worried about dumping by other countries, monetary policies in there, I think I would
put tariffs up, don't cut rates.
A weaker dollar opens the door to other central banks to cut rates.
Are we going to see more of the same in emerging markets as well? This conversation is going to continue. Breaking jobless claims just around the corner. From New York, this is Bloomberg. The opening now 60 minutes away. Equity futures on the S&P just about positive by 0.5%. On the Nasdaq, higher by 0.8. In the bond market, your scores look like this: 2-year, 10-year, and 30-year. Bond yield to higher by a single basis point across the curve. No drama here whatsoever. The 10-year, 429. The 2-year, 378. Jobless claims just around the corner. The estimate in our survey, 225. The previous number, 223. With an update, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, we're waiting for the numbers to drop here. They haven't quite yet, but we do have housing starts down 11.4%. Get back to that in a minute because jobless claims are down 215,000. That's down from revised 224 last week. So there's no news in jobless claims other than what Jay Powell said yesterday. The labor market seems to be in reasonably solid shape. 1,885,000 continuing claims. That is up a little bit from 1,844 in the prior week. 546 federal workers filing for jobless claims. That category so far telling us nothing about what's going on in the federal government firing space. Back to housing starts, down 11.4%. Building permits were up 1.6%. It doesn't look like this was a particularly good month for housing, but every time you talk housing these days, you hear the hold music in the background. There isn't much to say about what housing's contributing to growth. The Philadelphia Fed is one that we really kind of care about today. It may be the unusual day where it's really important, but prices received for the Philly Fed at 30.7 versus 29.8. So more inflation in the Philly Fed numbers. If you're Jay Powell, why would you want to cut rates right now? The prices paid index there at 51, up from 48.3. So inflation in the Philly Fed numbers, Philly Fed overall at 26.4, negative 26.4, down from 12.5. So we are talking about a real collapse of confidence in the manufacturing area around the Philadelphia Fed. This is not good news for the Fed, and it makes the argument both ways. For the Fed. Cut rates because confidence has collapsed. Leave rates where they are because inflation is up.
And Mike McKee, in many ways, the conversation hasn't really changed. Soft data not great, hard data OK. When you look at continuing claims, Mike, it's something that labour market economists have been referencing in recent weeks, that maybe there's evidence that once you're out of work, you can't get a job. What do you see this morning?
Not a whole lot of difference. I mean, what we see here is about a 40,000 increase. It doesn't tell you that there's any significant jump in the number of people who haven't been able to find work. And this number has gone up and down over the last couple of weeks. So labor market, as far as claims are concerned, is still showing the kind of strength it has been showing. And that doesn't give the Fed any reason to think that on a hard data basis, the economy is rolling over.
Mike, where are you on the debate of soft versus hard? Is it just a lag issue, 3 to 4 months, and then the hard data will reflect what the soft data, or is the soft data distorted?
The soft data is probably an indicator of how people are feeling at the moment because the headlines are all so bad. Will that carry through? Probably that depends, Mohamed, on what the president does. If he actually imposes higher tariffs and people see prices going up, they'll react. I'll go back to post 9/11 when consumer confidence cratered and then came right back up again, and people stopped spending for a little bit, but that recession was not a serious one because the country recovered fairly quickly from it. And do we see the same thing happen this time?
Mike, appreciate the update on the economic data there. Mike McKee, equity futures still positive by 0.6% in the bond market. Not much of a move, some stability here. Yields are up at the front of the curve by 0.1%, or rather 1 basis point. We're higher to 378. I'm getting tired. Yields unchanged on a 10-year, 428. Well, a turn to foreign exchange, and we'll talk about percentage point changes. Euro-dollar negative by 0.4%. Euro-dollar down to 115.30.51. The ECB rate decision out just moments ago, cutting interest rates once again, Mohamed, by 25 basis points. They seem to be in a very different position compared to, say, the Federal Reserve and Chairman Powell.
They are. They are at the opposite end of the Fed, and the Bank of England is in the middle of that distribution. But the press conference will be key here because how President Lagarde conveys the inflation dynamics, not just the growth dynamics. I think the growth dynamics are clear, but the inflation dynamics is going to be very important.
I couldn't agree more. The ECB president kicking off that news conference in about 11 minutes' time. The New York Fed president, John Williams, speaking at the moment, just said this: the economy is in a very good place. Lauren Goodwin of New York Life joins us now for more. Lauren, can I ask you, is the economy in a very good place?
I think the economy is in a pretty precarious place, but we're starting from a really strong base. Our economic scenarios coming into this year, we expected growth to slow from around 2.5% to just below 2%. We're now looking at 0.5% of GDP growth out of the U.S. this year. So it's not a recession, but that's a much more worrisome position, let's say, than we expected just a couple of months ago. And perhaps more important than that, though we have about a 50-50 percentage on recession versus not, we're pretty confident that we'll end the year with inflation higher than it is. And so as I see investors look around and say, maybe we'll wait and see how tariffs develop, see how monetary policy developed, I look at that expectation for higher inflation and I say, even if you were going to wait and see, do you have the portfolio that you need to wait and see when we have such inflation volatility?
Let's get into that in a second and just focus on the economy and monetary policy, and then we can get to the market calls. If you think the growth's going to come down from 3 to 0.5 and inflation by the end of the year will be higher than now, Chairman Powell is not giving us any clues on when he'd reduce interest rates. When do you think he'd reduce interest rates, if at all?
I think that the Fed will do as much as it can to do as little as possible. It's just very difficult to change policy credibly in a position where inflation and inflation expectations are so on the line. I completely agree with Mike that short-term inflation expectations that we're seeing out of consumers, out of businesses, have de-anchored in a meaningful way in reaction to how people feel right now. I expect that those will come down as reality proves to be less dire. But we're still in an environment where, in order for the Fed to avoid some of the worst case scenarios for the economy, cutting rates doesn't get you there. I don't think cutting rates does much to shore up supply chain challenges. Cutting rates certainly doesn't do much to manage inflation expectations in both short and long-term market interest rates. And so they're going to do everything they can not to move.
So your base case is stagflation?
Stagflation light, where you have a little bit of growth, but inflation moving up. And the difference between being in recession and not in recession, I think, is meaningful for the markets. But when we're looking at the economic scenario, not a whole lot of daylight between a sort of muddle through with inflation as opposed to an outright recession. Our lowest probability, about 15%, is for a recession that's deep enough and demand destruction is pronounced enough to actually bring inflation lower. I think that's the least likely scenario.
You mentioned things like trade and supply chains. The president was out this morning with a few different social media posts, but one of them was about the fact that he talked to Mexico, he talked to the Japanese negotiators. He says even China's waiting to come in. The Italians are here today. What if all these trade barriers and concerns are actually solved within 90 days?
For one, I think it's very unlikely, and expect that the average tariff rate will be higher in a couple of months than it was a couple of months ago, which has a meaningful impact on inflation. But perhaps more important, tariffs are a negotiating tool, but they're also a policy in themselves. We've been hearing from the administration that trade deficit is perceived as a sign of global economic weakness, and it's a challenge that the administration is looking to resolve. On top of that, if the goal of those policies in the end is to reshore some important supply chains, how far that goes remains to be seen. But even so, that's a very capital-intensive trend that, frankly, even if tariffs were completely rolled back and we shook our hands of the last couple of weeks, those capital-intensive trends are happening. They're underway. And so I see that as an environment where outright disinflation is unlikely.
So, Lauren, you teased the portfolio implications of everything we just discussed at the beginning of the interview. So what are they, and how far are investors from where you think they should be?
For starters, the 60-40 portfolio, and look, not all investors use it, but just as a baseline, the 60-40 portfolio was designed for a period where inflation and inflation volatility were low. That's not the situation that we're in right now, and so it's not the benchmark probably that investors should be using. For two, if you think about the last 15 years, the most effective asset allocation, if we're all honest with ourselves, would have been to be 90% invested in U.S. large cap growth equity. We got a couple of extra years of that, even as inflation rates have been higher because of the boom from AI. But as I look forward, I don't think that that's the allocation, that overweight U.S. equity allocation, that makes the most sense moving forward. So geographic rebalancing, I think, is important. We're definitely seeing that out of ex-U.S. investors already. I think U.S. investors need to do the same. We're also looking at building inflation resilience, whether that's in dividend payers or income generating equity, or by taking equity-like risk in credit or in the bond market. And we're considering some hedges for inflation volatility, those moments when you get inflation surprises, so including gold, real estate, other inflation-aware asset classes.
So the one thing you didn't mention is government bonds. You completely avoided government bonds. So let me take you there. What about government bonds?
So I have very high conviction that duration is a tactical bet at best for the foreseeable future. Now, we know that taking the 10-year Treasury bond as an example, there are three things that move the 10-year Treasury. The path of the Fed funds rate over that 10-year period, we're not seeing a lot of price expectation or changing there. inflation expectations, which have been pretty well anchored, but there's a wide dispersion of estimates so that it moves a little higher. And then the term premium, supply and demand issues. And not only in moves in the 10-year, but also in moves in currency, tell us that demand for treasuries is fraying a bit on the margin. And that makes sense to me, given what we're seeing globally. So that's an environment where I think the 10-year treasury yield is absolutely live between 4 and 5%. So if you can be in the market tactically and trade those moves, sure. But for the average investor that's making, 1 month, 3 month, 2 year changes, duration is not our favorite place to take risk.
Lauren, appreciate the clarity. It's good to see you. As always, thank you. Lauren Goodwin there of New York Life. Just finishing up there on the bond market. The bond market at the moment looks like this. Yields higher by a single basis point across the curve, up by close to 1 on a 10-year to 428. At the front end of the curve, 378. That's the price action. In just a moment, 5 minutes away from a news conference with ECB President Christine Lagarde following an interest rate reduction of 25 basis points. With an update on stories elsewhere this morning, here is your Bloomberg brief. Recapping the data out just moments ago, initial jobless claims falling to the lowest level in 2 months, coming in lower than expected at 215k. Continuing claims rising to 1.89 million, slightly higher than estimates. Elsewhere, the ECB cutting rates by 25 basis points, citing a deteriorating growth outlook thanks to rising trade tensions. President Lagarde speaking momentarily. We'll bring you those remarks live right here on Bloomberg. And finally, Nvidia. In the crosshairs of US-China trade tensions, the CEO, Jensen Huang, in Beijing after the Trump administration curbed the sale of its H20 chips to the country. Huang is reportedly meeting with clients, including the founder of DeepSeek. And that right there is your Bloomberg brief. Up next, we'll set you up for the day ahead and we'll catch up with ECB President Christine Lagarde. We'll take those comments live from Frankfurt, Germany. That argument at the commercial break was better than anything that's been on this morning. Do you want to continue? You good?
We don't agree on a
We're
few
live
things this morning.
Counting you down to the opening bell, 45 minutes away. Nice. Equity futures up by 0.6% on the Nasdaq, up by 0.9. Your trading diary looks like this. Today, President Trump meeting with the Italian Prime Minister Giorgia Meloni, and Netflix earnings coming after the closing bell tomorrow. Markets close for Good Friday. Next week, earnings season ramping up with results from Tesla on Tuesday, Wednesday, Boeing reports, and we'll get some PMI data Thursday, durable goods, and another round of jobless claims. And the President of the United States, no doubt, will have a few things to say on trade along the way. In just a moment, we'll have an ECB news conference for you with ECB President Christine Lagarde. Seeing live pictures out the corner of my eye. That's just commencing. When it starts and she starts to address people, we'll take that for you. But enough time for a final word around the table. A final word on a pretty interesting morning going into a long weekend.
I think the president's going to have a lot to say on trade today, but also he's going to be asked about these words regarding this, quote, termination cannot come fast enough for the Fed Chair Jay Powell. What does he mean by termination? The end of Powell's term next year, May? Or can he do something? Can he oust Powell? And the reason why I think this is an important moment is because the context of the Supreme Court basically giving the president the leeway to oust two top officials at independent agencies. And this is where I think me and Mohamed differ a little differently about what is going on in this moment right now.
I would just generalize what Annmarie just said and refer back to what I think is just one of the best headlines I've seen, which comes from Justin Fox's column in Opinion. Economic uncertainty has never felt this uncertain. I think that is such a powerful sentence.
I'm going to finish the week with some good news. In the bond market, some stability. There was great fear over the last week about a loss of safe haven status in the United States of America. We're ending the week with some stability, and let's hope it stays that way. The bond market pretty much unmoved. A special thanks to Mohamed, El-Erian for the last 2 hours on this programme. To you as well, Annmarie.
Thanks.
To Bramo, who's already getting ready for the long weekend. Thanks to Lisa as well, as always. Let's head over to Frankfurt, Germany, and hear from the ECB President Christine Lagarde following a 25 basis point reduction in interest rates.
Based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission, the disinflation process is well on track. Inflation has continued to develop as staff expected, with both headline and core inflation declining in March. Services inflation has also eased markedly over recent months. Most measures of underlying inflation suggest that inflation will settle at around our 2% medium-term target on a sustained basis. Wage growth is moderating, and profits are partially buffering the impact of still elevated wage growth on inflation. The euro area economy has been building up some resilience against global shocks, but the outlook for growth has deteriorated owing to rising trade tensions. Increased uncertainty is likely to reduce confidence among households and firms, and the adverse and volatile market response to the trade tensions is likely to have a tightening impact on financing conditions. These factors may further weigh on the economic outlook for the euro area. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of exceptional uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So the economic outlook is clouded by exceptional uncertainty. Euro area exporters face new barriers to trade, although their scope remains unclear. Disruptions to international commerce, financial market tensions, and geopolitical uncertainty are weighing on business investment. As consumers become more cautious about the future, they may hold back spending as well. At the same time, the euro area economy has been building up some resilience against the global shocks. The economy is likely to have grown in the first quarter of the year, and manufacturing has shown signs of stabilization. Unemployment fell to 6.1% in February, its lowest level since the launch of the euro. A strong labor market, higher real incomes, and the impact of our monetary policy should underpin spending. The important policy initiatives that have been launched at the national and EU levels to increase defense spending and infrastructure investment can be expected to bolster manufacturing, which is also reflected in recent surveys. In the present geopolitical environment, it is even more urgent for fiscal and structural policies to make the euro area economy more productive, competitive, and resilient. The European Commission's Competitiveness Compass provides a concrete roadmap for action, and its proposals, including on simplification, should be swiftly adopted. This includes completing the Savings and Investment Union, following a clear and ambitious timetable, which should help savers benefit from more opportunities to invest and improve firms' access to finance, especially risk capital. It is also important to rapidly establish the legislative framework to prepare the ground for the potential introduction of the digital euro. Governments should ensure sustainable public finances in line with the EU's economic governance framework and prioritize essential growth-enhancing structural reforms and strategic investments. Annual inflation edged down to 2.2% in March. Energy prices fell by 1% after a slight rise in February, while food price inflation rose to 2.9% in March, from 2.7 in February. Goods inflation was stable at 0.6%. Services inflation fell again in March to 3.5%, and it now stands half a percentage point below the rate recorded at the end of last year. Most indicators of underlying inflation are pointing to a sustained return of inflation to our 2% medium-term target. Domestic inflation has declined since the end of 2024. Wages are gradually moderating. In the last quarter of 2024, annual growth in compensation per employee stood at 4.1%, down from 4.5% in the previous quarter. Rising productivity also meant that unit labor costs grew more slowly. The ECB's wage tracker and information from our contacts with companies point to a decline in wage growth in 2025, as also indicated in the March staff projections. Unit profit fell at an annual rate of 1.1% at the end of last year, contributing to lower domestic inflation. Most measures of longer-term inflation expectations continue to stand at around 2%, which supports the sustainable return of inflation to our target. Let's look at the risk now. Downside risks to economic growth have increased. The major escalation in global trade tensions and associated uncertainties will likely lower euro area growth by dampening exports, and it may drag down investment and consumption. Deteriorating financial market sentiment could lead to tighter financing conditions, increase risk aversion, and make firms and households less willing to invest and consume. Geopolitical tensions, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, also remain a major source of uncertainty. At the same time, the increase in defense and infrastructure spending would add to growth. Increasing global trade disruptions are adding more uncertainty to the outlook for euro area inflation. Falling global energy prices and appreciation of the euro could put further downward pressure on inflation. This could be reinforced by lower demand for euro area exports owing to higher tariff and a rerouting of exports into the euro area from countries with overcapacity. Adverse financial market reactions to the trade tensions could weigh on domestic demand and thereby also lower inflation.